This is a very different Fed cycle because it's a recalibration of policy.
This is a Fed just sort of right-sizing policy, given the fact that inflation has slowed.
What measures are they willing to tackle from a fiscal perspective without, again, upsetting this economy, which remains still strong?
Essentially, what we've discovered is that there's an underlying resilience that just can't be ignored.
I think they want to cut rates, but I don't think they're in a rush to do it. And I don't think the economy is going to give them the excuse to do it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance from New York with equity futures on the S&P 500 up by 0.2%. It's day two for Chairman Powell, and down in Washington, D.C., it's the State of the Union address for the President of the United States. We'll catch up with AMH down in Washington in just a moment. Before we talk about day two, I want to talk about day one. It was a win for Wall Street, Bramo, but not the kind of win we were thinking about. This wasn't about monetary policy. This was about financial regulation.
So there are some lobbyists in Washington, D.C. Congratulations. You're getting massive bonuses, and I imagine that you're getting a lot of pats on your back, because what we saw is that 19% capital requirement that a lot of the largest banks in the U.S. were going to have to hold under new proposals, basically wholesale, presumably being rolled back by Jay Powell saying, well, we're going to make a lot of changes to this after a lot of lobbying.
So day one was in front of the House Financial Services Committee. Day two today is in front of the Senate Banking Committee. Go through the members of the Senate Banking Committee. The Senator from Massachusetts, Elizabeth Warren.
Yeah.
I imagine Senator Warren has got some follow-up questions about what was said yesterday.
I imagine she's not going to be particularly happy at a time when people are looking for the potential of too big to fail, consolidation of power. JP Morgan shares at another all-time high. I mean, just surging, even though we still see the turmoil at New York Community Bank ongoing. Here's the issue. Has it become unduly punitive for these banks? And how do you create a scenario where there just isn't a gravitational force to them in every which way at a time when the smaller banks are facing a whole host of headwinds that are much different from the big ones?
You mentioned all-time highs. So all-time high for JP Morgan Monday, record Tuesday, record again on Wednesday. If you want some price action, NYCB, I just want to give you the high and the low on New York Community Bank. At the lows, we were down 47% in yesterday's session. At the highs, we were up 37%. We were facing real existential risk-type stuff. We've got a new CEO. Again, I think a week since the last time we got a new CEO. And this time we've received an equity investment from former Treasury Secretary Steve Mnuchin.
This is an amazing story to me. First of all, we should note that the fluctuations come with a share price of $3.46 at the close. So trading kind of like a penny stock. Stephen Mnuchin, though, he is trying to reprise his reputation after some real questions before the mortgage crisis with his involvement in a couple of small banks. It raises a lot of questions. How is he going to deal with the whole rent-controlled buildings where basically any investment you put in, you can't pass along to the renters because there are certain rules prohibiting that? How do you extract value after years and years of basically becoming something you're accused of having some more punitive practices?
With great difficulty. In the pre-market, at least, we're positive again by 4%. Should we talk about monetary policy?
Please.
I think we can do that briefly. The door's wide open to strike a hawkish tone. Data's been really strong to start 2024. Data that he did not have at the last Fed meeting in the news conference at the end of January. He didn't walk through it. How much signal is in that?
He's not concerned about financial conditions. He indicated that in the December press conference, and that, frankly, is what this message is, and it's loud and clear. And so it's basically signaling you guys can keep going.
The drip feed of labour market data continues this morning. We'll get jobless claims in about 2 hours and 30 minutes' time before the big one tomorrow. It's payrolls Friday. Here's the equity market for you on the S&P 500. Equity futures shaping up as follows. We are positive by 0.2%. Yields are going nowhere on a 10-year, 4.10 on a 10-year this morning. In the FX market, ECB decision a little bit later. The euro treading water, 108.96. Coming up this hour, Sharon Bell of Goldman Sachs as Fed Chair Jay Powell sticks to script on Capitol Hill. Mohammed Yunus of Gallup as President Biden prepares to deliver his State of the Union address. And Dan Ives of Wedbush as Tesla and Apple look less than magnificent. We begin with our top story. Chairman Powell giving a boost to stocks, sticking to script on Capitol Hill. Sharon Bell of Goldman Sachs looking for the rally to broaden out, saying this: typically, after a narrow market rally, the rest of the market tends to catch up. With a handful of stocks stocks that have led the rally. Which sectors have been catching up? It's cyclicals, ex-technology. They've outperformed defensives by 8% over the past 3 months in Europe and 5% in the US. To discuss, I'm pleased to say that Sharon is with us right now. Sharon, an equity market yesterday that rallied even with Google, Tesla, Apple lower at the close. What's the signal in that?
Yeah, I mean, you've had all these fantastic big cap tech stocks which have delivered great earnings in many cases, to be fair, do just so incredibly well. The valuations have gone up, the market's become very concentrated. So I think you're getting a little bit of this broadening out that you mentioned. The information in it is just that there is still quite a lot of cash out there looking to invest in equity. But, of course, these Magnificent Seven stocks are already a big share of the market and people want to diversify a bit.
Sharon, I'm struck by the fact that people say this rally is not hinged on some idea of rate cuts. And then when the prospect of rate cuts escalates, the rally continues. Which is it? Do rate cuts matter to keep this rally going or don't they?
I think, so honestly, I think the rally at the end of last year, that was somewhat driven by rate cut expectations, inflation coming down, etc. So far this year, clearly not, because if anything, people have pushed out their view, including ourselves, of when the Fed is likely to first cut rates, and other central banks too. I think it's been the activity data in the US has been good, and of course the earnings of US companies has been good. So I think it's driven by both those things, and more recently probably more activity.
So are you saying that this rally could continue even if we get no rate cuts this year and we basically get an ongoing strength that we've seen so far in the data? And I want to ask this before we get into some of the composition, because ultimately this has sort of fueled a lot of the optimism, this idea that it can continue even with no rate cuts potentially, as Torsten Slok of Apollo has said.
Yeah, I don't think it would continue if you got no rate cuts unless the economy was absolutely stellar. And I think we're expecting the Fed to start cutting from the middle of this year, really from June. Same for the ECB, same for the Bank of England. I think it would be a big disappointment to markets if that was pushed out further. So yeah, there's a limit to this. I feel that ultimately interest rates, they're seen as relatively tight at the moment, quite restrictive, and that ultimately they need to come down in order to justify some of this rally that we've had since October last year. So no, I don't think you would get a really strong rally without some relief from rates this year. But of course, there's a balance, to the extent that it's just phenomenally good growth, let's say. Perhaps you could push rates out a little bit further, but there is a limit to it.
We've heard it twice already this week. We had it from Torsten Slok of Apollo, no rate cuts this year. Steve Rizzuto yesterday from Mizuho saying no rate cuts this year. Sharon, even with that, a lot of people are still constructive on this equity market. Can we talk about where they have been more than constructive? Euphoria. Maybe. Bank of America say signs of euphoria are quite narrow and contained to thematic secular themes. Things like AI, think NVIDIA. Things like GLP-1s, weight loss drugs, think Novo Nordisk. Sharon, do you see any signs of euphoria at all?
Yeah, I definitely see signs of excitement. People are pretty happy with the growth that you're seeing from those companies. The valuation of the Magnificent Seven has gone up. The valuation of the overall US stock market, which of course includes those that are a big weight in them, has gone up. It's kind of at the top of its range for the last 20 years. But what it isn't at is the same bubble levels you got to in previous periods where you could argue you had euphoria and things like the tech bubble in the late 90s or early 2000s. Then you got to a much higher valuation, particularly of the largest seven stocks then. I think they traded in the sort of 50 times PE, whereas the Magnificent Seven now trade around half that. So absolutely high valuation versus history, and that's a constraint on the market. It's one of the reasons I don't think equities really rally unless you do get those rate cuts, but not bubbly, not euphoric levels in that sense.
Sharon, as you know, Wall Street loves an acronym. It was FANG a decade ago for the best part of 10 years, and then it was the Mag 7 last year. And the Mag 7 seems to be breaking up. What's amazing to me is we've been talking about the granolas with you and the team for quite a while, and all of a sudden everyone's started to catch on to what is happening over in Europe. Sharon, have you noticed that? Clients being, I guess, more engaged with what's taking place in Europe, what's developing?
Definitely, absolutely. I think there's lots of reasons for that. One is that there's been a lot more coverage of the granolas recently in the press, but I think also the reason for that has been they perform really well. And another reason is people are worried about this concentrated performance in the Magnificent Seven in the US. They're worried about the risks related to that, and they want to look elsewhere. Are there other companies elsewhere that look interesting that we could invest in? The granolas, they have performed very, very well, and I think that's the reason. And another thing to note about this group of companies, only if they perform well in the last couple of years, they perform well, but on much lower volatility than the Magnificent Seven and lower valuations. And of course, that's got people's attention.
The one thing about the granolas, Sharon, is it strikes me that perhaps they're more exposed to the China risk more than the U.S. companies, just simply because if you think about luxury, weight loss, some of the drugs are even manufactured in China. And then you have, of course, the tech giants in Europe. How much is that sort of in your calculus? How much has that sort of dampened the rally, or do you see it dampening the rally going forward?
Yeah, definitely. I think Europe overall is more exposed to China than the US. One thing I often argue with Europe, because the pushback I get on European stocks is that European economies are extremely weak. Fair point, I would often say, but then 60% of company sales are outside of Europe. So normally that you sell that as a good thing for large cap listed European companies. But of course, they do have quite a lot of interlinkages with China and exposure to China. Definitely, the Chinese authorities are trying to boost consumption at the moment. Travel, I think, Chinese travelers will pick up a little bit, particularly around the Asia region, and that, of course, will help luxury goods sales. And those companies are in our granolas. I also think the wealth effect of a strong US stock market helps some of those luxury and branded consumer goods companies in the granolas. So yes, there's definitely exposure there, but it's a bit of a mixed bag as to whether it's good or a negative.
So we're booking our NVIDIA gains and we're buying handbags from LVMH.
That's exactly
Is that where your mind was going?
That was exactly where my mind was going. I'm thinking to myself, so all those stock investors are cashing out. Those NVIDIA insiders who cashed out for some $180 million, then are going and buying a lot of Hermes scarves.
Sharon Bow, thank you. It's good to catch up. Sharon Bow there of Goldman. We talked a lot about granolas. I'll tell you what the name means. GSK, Roche, ASML, Nestle, Novartis, Novo Nordisk, L'Oreal, LVMH, AstraZeneca, SAP, and Sanofi.
Basically, weight loss, big tech, and then, of course, you have your luxury players. That's basically it in a nutshell.
Some style. I just want to deliver you a bit of a programming note. A little bit later this morning, just a fantastic guest for you. Howard Marks of Oak Tree Capital is going to join us at around 8 a.m. Eastern Time, so a couple of hours from now. I was going through his memo from earlier on this year. There's some great lines in this. Here's the first one. The worst of loans made at the best of times. And as a quote in this piece, I love Hayek's word malinvestment because of the validity of the idea of making behind it in low return times. Investments are made that shouldn't be made. Buildings are built that shouldn't be built. That line there, I want to know how many buildings did we build that should not be built?
Well, and then this raises this question about China as well, because he's actually been active in China. But you're correct. Basically, he's talking about the zombies that were kept alive during those times and have unsustainable business models. He talked about the 6-foot man who drowns in a 5-foot deep water because he's unstable. Leverage.
It's a great piece. We're going to catch up with Howard a little bit later on this morning. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speculation is rising that the Bank of Japan will hike rates in March. Those bets are gaining traction after reports emerge that some BOJ officials favor an early move and higher wage growth. Investors are largely in agreement that the central bank will scrap the world's last remaining negative rate either this month or next month. President Biden's top economic advisor has successfully pushed the upcoming White House budget forecast to present a rosier view. National Economic Council Director Lael Brainard disagreed with the forecast for 10-year yields in the budget plan, pressing for a lower rate, which would have the effect of an improved overall outlook for growth and inflation. The budget forecasts are due for release on Monday. Shares of Novo Nordisk gaining after the Danish drug maker released promising data on an experimental daily weight loss pill. The company says a new treatment helped patients shed 13% of their weight over 12 weeks of use. In a meeting with investors, Novo said the study was small but provides a basis for further development of that pill. That's your Bloomberg Brief. John.
Another one. Danny, thank you. Coming up next on this program, Biden gearing up for the State of the Union.
We're not going to be moved into being threatened to default on the debt if we don't respond. I stand here tonight after we've created, with the help of many people in this room, 12 million new jobs. More jobs created in 2 years than any president's created in 4 years.
Catching up with AMH up next on the program, live from New York. This is Bloomberg. Live from New York, Chairman Powell Day 2 coming right up. Equity futures on the S&P positive by 0.2%. Yields just about unchanged, 410 on a 10-year. Under surveillance this morning, Biden gearing up for the State of the Union.
We're not going to be moved into being threatened to default on the debt if we don't respond. Some of my Republican friends want to take the economy hostage. I get it, unless I agree to their economic plans. I stand here tonight after we've created, with the help of many people in this room, 12 million new jobs, more jobs created in 2 years than any president's created in 4 years. Make no mistake about it. As we made clear last week, if China threatens our sovereignty, we will act to protect our country, and we did.
It's the latest. President Biden set to deliver his State of the Union address, highlighting his success and charting a path forward. Biden hoping to convince voters he's ready and able to serve another term on the heels of a Super Tuesday that solidified a rematch between him and Donald Trump. Annmarie joins us now from Washington, D.C. AMH, I want to go to some reporting from Axios and share this quote with you. Biden needs a cure for what some advisors call Trump amnesia, the notion that the chaos and unpopularity of Trump's presidency has receded from some voters' memories nearly 4 years on. Is he going to be speaking to those people today?
Absolutely, Jonathan. What the administration and the campaign want to remind people is where we were not just 4 years ago. Remember, March 2020 is when we started the COVID lockdowns, when people lost their jobs, they were at home. And he wants to remind them that that happened under the Trump administration. So, one, they want to paint a picture that they don't think the Trump administration had the correct strategy when it came to COVID. And then, of course, they're going to want to have this theme about democracy versus autocracy. And they're going to want to remind people what happened after Biden won that election and what happened on January 6th. They want to try to remind some of this, the imagery, the rhetoric that came from the former president, because we've heard from President Biden time and time again. He constantly says, do not judge me against the almighty, judge me by the individual I'm up against. And that is what he is going to try to relay today when he talks to the American people.
How much of the dollars and cents are we going to hear about? Because that's what I'm curious about, the actual budget, exactly what he can propose given some of the caps, and his projections in the deficit given a disagreement over what the actual benchmark rate will be.
Well, Lisa, this is his opportunity, and Greg Valliere is calling it his most important speech of his presidency. And I think a lot of people in Washington view it because yesterday showed with Nikki Haley dropping out that long shot bid she has. This is firmly a rematch of Trump versus Biden. So if he starts really getting into the nuances of the deficit, yeah, you and I might be interested, but he might actually lose the American electorate. So the president is going to want to focus on, when it comes to the budget and it comes to securing money to keep the government open, he's going to want to push back on Congress. He's going to say that it took them this long and we still do not have those 12 appropriation bills. He's going to talk about the fact that it was under the former speaker that he struck a deal, and now this new speaker hasn't been able to put over the finish line. So he's going to try to categorize that as not his problem, but the chaos in Congress. And we have an individual now who can talk about all of this and where we are right now in the Biden presidency. It's Mohammed Yunus, editor-in-chief at Gallup. Mohammed, thank you so much for joining us. As I've outlined there, this is a tough speech for the president in the sense that it's hinging on his reelection campaign. Where is the electorate right now when it comes to Joe Biden?
Not in a great place. I mean, I would agree. This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics that we've relied on historically to gauge how strong a president's position is going into re-election.
And we have one of his lowest election polling right now in terms of his disapproval rating. What is the top issue right now that Gallup is seeing?
The number one issue that really is rising in potency is immigration. Today, we ask Americans a question every month. What's the most important problem facing the country? Right now, we see a sudden rise in immigration, and it's steady. 28% of Americans say that immigration is the most important issue facing the country. But not just that, Annmarie. Over 50% of Americans now describe what's happening at the southern border as a critical threat to the vital interest of the U.S. So more Americans are starting to perceive this not just as a policy issue, but as a security issue that they're concerned about.
Border encounters have risen under this administration. It's at a record. It wasn't like that under Obama, and Biden was VP there. What makes their policy so different?
I don't think it's a matter of policies being different. I think it's a matter of how people are reacting based on their own party identification. What's interesting this time is that an increasing number of Democrats are also starting to see what's happening at the southern border as a critical threat to the United States. I think also what President Obama was not facing was a President Trump that's very vocal and effective at drawing people's attention, at least his side of the aisle, to the issue of immigration, because they know, as Republicans, that that's becoming a very potent issue and not just one that squarely the Republican base is concerned about.
And that's right. You hear a lot of people talk about that now. Every city, every state is a border state. I was struck because everyone talks about it's the economy's stupid, and that's what wins or loses election. Yes. But Gallup is showing that it is immigration. So what did Biden need to say tonight to make sure that, to tell the American people that he is going to do something? Because so far he hasn't decided to go for an executive order.
Absolutely. And it is important to note the economy has proven to be the most important issue for voters over time. I think tonight what President Biden is going to try to do is piggyback actually off of what you said on the budget deficit. He's going to try to identify government dysfunction as something he's been trying to solve and isn't a part of, whether that's immigration, whether that's the situation with the deficit or any other issue. Americans, the other issue other than immigration that's been at the top of that most important problem list is actually poor government and poor leadership. So Americans are very fed up and frustrated with Washington for a whole slew of issues. I think President Biden is going to try today to present himself as a problem solver who's been very, from his perspective, adept at addressing some of those issues despite the dysfunction.
I get the sense from a lot of reporting he's going to deflect a lot to Congress. That might be hard for the electorate, though, that says, well, we've given you 4 years to try to fix some of this. There's one area in your polling where he does well. And I want to bring this up because Jill Biden, the First Lady, will be having the Swedish Prime Minister sit with her and her colleagues. When it comes to NATO, yes, this is something Biden is able to really harp on and distinguish himself from Trump.
What's really interesting about NATO is we just got our data back 2 years after the beginning of this war in Ukraine about whether Americans, how they feel about the current support level that the U.S. is giving NATO. And what we find is that essentially there's been no backing off from the American public's perspective on the importance of backing NATO. Now, there hasn't been an astronomical increase in people wanting to send more money. But the notion that Americans are kind of losing faith in NATO, or it's not that important, or we could have left NATO per their previous president, that sentiment doesn't seem to be gaining any traction with the American public. And for President Biden, I think that's a sign of relief. He doesn't have a lot in the public opinion data that we have right now, but that is one of them.
So this is one bright spot. I want to end on former President Donald Trump. He never topped 50% in your Gallup polling. What does that say about his electability?
I think it depends on turnout, right? I mean, he's won before. So to debate his electability, I think, is an interesting exercise. What we find historically is that presidents without a 50% approval rating or higher do not make it to re-election. And in fact, President Biden is significantly behind that mark. President Trump was as well. It's interesting to note that one of the other questions we ask is whether or not the president in power deserves re-election. Mm-hmm. And what's really interesting is that President Trump actually had 50% of people saying that just about a year before he ran for re-election, and the economy turned very dramatically in the negative because of COVID, and that fell apart significantly down to like 43%. So on a series of issues, President Biden is behind, but he's definitely going to try to focus on his strong points.
Mohammed, thank you so much for joining us. Jonathan, that was Mohammed Yunus of the Gallup Group. You heard it there. Immigration, the economy, top two issues on voters' mind, and likely what Biden will be addressing this evening.
Mesh, thank you. Looking forward to catching up with you a little bit later. Bramo, I know this winds you up, but just to sort of frame how much the political discourse in Washington and this country has fallen away. The reaction to this later is going to be like a college professor, maybe even a high school teacher, to a presentation made. They're going to be talking about the delivery, the energy behind it, the style. That's what the takeaway is going to be at the end of this.
What he wears, how he greets Joe Biden, how hard he pushes against the former President Donald Trump, exactly whether he enters into the fray or not. It's not going to be talking about yield forecasts, which actually are really important. There was a really interesting debate on that in the administration.
What did you make of that with Lau Brainerd?
To me, my takeaway is it just shows how difficult it is to forecast this deficit and also just how to massage the numbers to make them a little better.
Politics or economics? Which one? Coming up next, Simon French of Panmure Gordon on the ECB. That decision a little bit later. Chairman Powell, day 2, later this morning. Here's the price action. Yesterday, stocks bouncing back on the S&P 500 from the biggest one-day loss so far this month. Equity futures this morning positive by 0.16%. Just as interesting yesterday, the fact we bounced, and Lisa, we talked about this briefly, we bounced even with Apple, Tesla, Google, still struggling and negative at the close.
There's a feeling that those are tired, that the rally is sort of losing steam without some more sense of how much the Fed may cut rates. What I find interesting is exactly to your point. It isn't, oh my God, the world is falling. It is, what else can I buy that might be better? And that's a different kind of very risk-on feeling.
Banks and JP Morgan, apparently, based on the price action so far this week on that particular name, another all-time high at the close yesterday. Let's turn to the bond market, 2-year, 10-year, 30-year. I want to sit on the 2-year briefly. So a week ago, we had a little look at 470. We backed away to 455.35. Yields unchanged this morning. We've had some data this week. So far, OK. ISM was soft. ADP was OK. Jolts were OK. I think we're taking some comfort away from the fact that these weren't massive beats like what we saw in January, and that's helping to keep a lid on this bond market.
You know, yesterday the JOLTS data was actually really interesting. And what I'm really kind of looking at some of these more peripheral indicators more and more, especially the more that people raise questions about all of the data. But Ian Shepherdson over at Pantheon was pointing to the fact that the quits rate is coming down dramatically, and that usually leads the sort of employment index, cost index. To me, the fact that it's coming down so significantly is also giving some sort of comfort to people to go in and buy. I know it sounds like it's peripheral, but this is the level that people are going to, and you can see the price action in the market.
That's about how much confidence you've got in the labour market. I think that's the ultimate data point. If you can really get some detail on it, if you really believe it, that's the ultimate data point, and maybe even more so than, say, average hourly earnings, which Tom Porcelli of PGIM pushed back against yesterday.
That was wonderful. He's just like, I hate it. It's fake. Don't look at it. Basically, if people have confidence to quit, that means that they have confidence they can get another job. If they don't, that means they won't have the confidence not only to get another job, potentially, even to demand higher wages, which is the reason why it often leads that wage inflation index data that a lot of people look at.
That's the US and wage growth. Let's talk about Japan. Do you want some price action in the FX market? You've got some. Dollar yen. This is a move of more than 1 full percentage point, 147.80. This is a clean break of 150 now, 147.80, and the biggest one-day move lower on this currency pair of the year so far. So based on some Bloomberg reporting, actually, let's go through two pieces of this. Point one, BOJ officials gaining more confidence in the wage growth story. Point two, government officials actually OK with maybe a near-term rate hike from the BOJ.
So I was looking at that and this idea that we got this big move and now you've got a 70% chance of some sort of rate normalization. I say normalization, getting it back to zero for the first time since 2007. You're getting the sense that 70%, there's a 70% chance that they're going to actually do this. Is there a window now? I think that's what people are saying, to get it done before something has to stop them, right? So basically, do they want to get more ammunition and they want to get more credence to the yen at a time where there's relative calm in the world, and they can do it with data that supports them?
That's the standout in foreign exchange this morning. Dollar yen 147.78, a move of 1%, the third consecutive day of yen strength. Under surveillance this morning, our top stories: Houthi attacks in the Red Sea turning deadly. 3 crew members were killed aboard a commodities carrier just yesterday. Another 2 crew members were injured, and the ship named True Confidence has been abandoned. These mark the first confirmed deaths of crew members since Houthi attacks started in the busy shipping lane back in November. Talked a few times about a State of the Union, foreign policy, and our inability to contain what's happened in this part of the world is a big issue.
Inability or unwillingness or both. And to me, this is what really struck me, is that we're not talking about this every day and it's still happening. That we have to talk about actually an escalation and, oh yeah, it's not even the top story. And I wonder, is this the U.S.'s way of saying, look, Europe, this is your problem. You're the ones that are getting affected by this much more. You handle it. We're not going to step in and rescue you. If that's the case, how does he then talk about mending ties with all of the NATO members?
Without a doubt, the foreign policy story will be dominant a little bit later on today, and no doubt dominant through the rest of this year. Let's talk about Chairman Powell. Fed Chair Jay Powell sticking a script on day one of Capitol Hill testimony, saying policy is likely at its peak, but expects to ease policy as confidence grows. Inflation is headed back towards 2%. Powell also pushing back on Basel III banking regulations, saying this: I do expect there will be broader material changes to the proposal. It's more important that we get this right, that we do it fast. Powell is back on Capitol Hill to face the Senate a little bit later this morning, something like 10 a.m. Eastern time, and I have no doubt they're going to be picking up on those comments on financial regulation and not just monetary policy.
It's almost as if Elizabeth Warren is sort of wringing her hands in excitement. Well, seething, yes, but also very excited for the promotional material she could put out afterwards. Look, there are some questions about why this venue. You know, is this something that he meant to do and sort of to take out of the realm of the Fed Vice Chair of Supervision, Michael Barr? I just wonder, does this mean that basically the banks won? That they're lobbying, they lobbied, they said, we don't like this, and he's like, okay, cool. That's fine. We'll take it out.
You say the banks won, but maybe common sense did. Because when you heard from the argument, when you really got into the argument against this decision, it kind of made sense. It was hard to poke holes in.
Fair, but if that's the case, is this the way that they want to go about basically saying, yeah, we're just going to overhaul it? I mean, if you want to talk about messaging and the gait of somebody and just the enthusiasm of someone and all the different kind of messaging we're going to be talking about ad nauseum, what kind of messaging does it send to the market to come out and just say, yeah, we're going to overhaul the whole thing?
You're talking about the optics of Joe Biden's gate. Is that what that comment was about?
I mean, that's what we're going to be talking about tomorrow, unfortunately. But this is my point, is that, you know, why did he do it in this manner? Because if it is logic prevailing, typically what you do is you just quietly put something out that's completely overhauled, and you just hope that nobody notices.
It's a sort of classic Jay Powell to do those kind of things in testimony, right?
I mean, it just doesn't...
It's on brand.
It's not like CVS, 60 Minutes, everybody, I understand, I feel your pain. This, not so much.
This was on brand. Let's get to this. NYCB, New York Community Bank, raising over $1 billion in equity, led by former Treasury Secretary Steve Mnuchin. The infusion coming from Mnuchin's Liberty Strategic Capital and other partners too. NYCB plunged during yesterday's trading after reports grew that the bank was seeking new investments. The bank also naming Joseph Otting, the former controller of the currency, as its new CEO, after naming a CEO something like a week ago. The stock ended the day positive, but Bramo, this one was all over the place in yesterday's session. I think we were having a real conversation yesterday before these headlines broke about whether this bank would actually survive the week. That's a big issue.
We have to repeat something that you mentioned earlier. We're talking about this bank still. We're not talking about other bank stocks, which are actually doing just fine. You are seeing some turmoil from some of the regionals, but not even. So this is really something that's contained. What did you find most interesting about this? Because I know what I did. What did you find most interesting?
The regulators coming on board to run the bank. I think that's a piece of it. Steve Mnuchin, the former Treasury Secretary. There's
100%.
Loads of pieces of this.
I mean, to me, it's sort of who is coming in, why are they coming in? Is this some sort of indication of a policy shift that could maybe create some of more value in some of these rent-controlled buildings? Is this because he wants to reprise Steve Mnuchin his reputation after some, you know, issues before the financial crisis? I mean, it's now a personal intrigue story, no longer a market story.
It's an amazing story, an amazing story we'll continue to talk about through this morning. I want to talk about this too. Got an ECB rate decision a little bit later this morning, just under 2 hours away, actually. Simon French of Panmure Gordon expecting the ECB to be the first to cut rates in June and the Fed to go a little bit later, writing this. We have staggeringly moved from being one of the most hawkish on the street to now being comparatively dovish as the no-landing scenario comes into view. Powell's testimony, alongside yesterday's JOLTS data, suggests that July remains the most likely for the first federal funds rate cut. Simon French, I'm pleased to say, joins us from London. Simon, let's start with the Fed and then we'll get to the ECB. Why July for you?
Well, July in terms of the testimony we got from Jerome Powell in terms of loosening monetary policy in the second half of the year. You don't want to leave it too late, given the obvious political cycle that the US economy is going to move into. So you talked, I thought it was a really interesting conversation about the space for the BOJ, the policy space for the BOJ to go in the opposite direction and start hiking rates. I think the start of H2 is the most obvious policy space for the Fed to get the first inflection point in policy out of the way. I mean, my quote, though, really reflects how the market has really moved from a position of seeing it almost a nailed-on certainty of happening in Q1 to much more where we thought it was going to be. And to be fair, Jay Powell facing down the bond market throughout the last 12 months and saying it'll come later than you all anticipate. He's been proved right time and time again. I think he'll be proved right a further time following this testimony.
There's some speculation, as you know, Simon, on this side of the Atlantic as to whether they might cut at all this year. Apollo saying no, Mizuho saying no. And the reason for that, as you know, Simon, is the data so far this year has been pretty decent in America. Can you strip out the US and tell us just how weak is the rest of the world, ex-US, right now?
Well, there's two world economies at the moment. There's the US and there's everyone else, largely. And that really is as simplistic as I can put it. And that's a real challenge when you have financial conditions at a global level largely made by a central bank, the US Federal Reserve, who is, and I I've noted over recent years them take a slightly more multinational view of economic trends, but still overarchingly dominated by US economic data. I think that's a real challenge given the two-speed nature of the world economy, with one pole so much stronger than the others.
Which raises this question of what the ECB is going to say, in particular, Christine Lagarde, when she comes out today. Is she going to try to push against these ideas of a rate cut in the near term or before the Federal Reserve, or is she just going to get political and talk about Trump again?
I think she will try and dampen down expectations of an imminent rate cut from the ECB, although, as I say in my notes, the ECB, I think, will be the first major central bank to move to cutting rates based on the fact that actually the interpretation of the inflation data, and this will be what I'll be quite keen to hear from Christine Lagarde, is key. On one level, year-on-year core HICP, so inflation in the Eurozone, is 3.1%. Away from target, 110 basis points above target. You take the way that American, US economists prefer to look at inflationary trends and look at the annualized 3-month data, which I think with such big base effects is a much better metric. Actually, Eurozone core inflation at the moment, 1.1%, a very, very different narrative. Which data point and which interpretation of the same data is taken is actually going to be quite key for the messaging at lunchtime.
Simon, I'm also curious about some of the thresholds that would make it difficult for them to cut rates. And I'm thinking, for example, of what we were talking about with the Houthi attacks in the Red Sea. This obviously affects the Euro region much more than the U.S. with respect to price pressures. And Christine Lagarde's talked about it before. Does that type of price pressure make it less likely that they'll cut rates? Or is that some exogenous kind of effect that's less relevant?
Well, Lisa, I think what you've got here is the recent history since the last macroeconomic forecast from the ECB back in December, which the backdrop is the natural gas prices, which is such a driver of headline inflationary pressures and spillover into core inflationary pressures, has come down about 40%, largely because of a very warm European winter. And that has meant that I expect when we see the macroeconomic forecast, that 2.7% inflation forecast for 2024 that the ECB had in December will actually go down. But it is the degree to which those geopolitical events, you mentioned the attacks by the Houthis in the Red Sea, means that a more forward-looking view on inflation is much more hawkish. This is one of the challenges of conditional forecasts, taking in spot prices right now, risks always being somewhat lagged in terms of those macroeconomic projections if you anticipate that geopolitical events like this will be far more inflationary going forward than the current spot curve is pricing.
Simon, just a final question. How united is the Governing Council on the ECB at the moment?
Totally split. And look, this isn't a criticism per se. It's different interpretation of those data points. And I've given you two ways of representing the same data based on whether you annualize or year-on-year adjust it. But also, and this is where I go back to the broad basket of cyclical indicators, money supply, consumer confidence, the PMIs. 12 months ago, it was relatively easy for the ECB Governing Council to set a single monetary policy stance. You had a very similar speed of the major Eurozone economies. But if you compare the fastest growing Eurozone economy, Spain, with the slowest growing Eurozone economy, Germany at the moment, that spread has blown out massively over the last 12 months. Makes it much harder to have a united ECB Governing Council when setting a single policy rate.
Also slightly confusing, Simon, because now the hawks are in Germany and they're looking at weak growth, and typically the doves are in Spain. And I've got to try and get my head around that. Simon, thank you, sir. Simon French of Abramowicz and Annmarie Hordern. Talk about a change in the Eurozone, hey?
I mean, it just raises this question of, do you end up with perhaps more dovishness out of the hawks just simply because they're the ones that need it more than anybody else?
It's kind of bizarre right now. The ECB decision, 1 hour, 31 minutes away in about something like 15 seconds. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump wants to debate Joe Biden. The former president posted on Truth Social, quote, "I am calling for debates anytime, anywhere, any place." During the Republican primary, Trump did skip 5 debates. A Biden campaign spokesman says if Trump is desperate to see the president in primetime, he can watch the State of the Union tonight. Abu Dhabi is now Brevin Howard's biggest risk-taking center. Sources say the macro fund now runs about $10 billion from there. That's just under a third of its assets, and more than it manages from London or New York. The U.S. government is set to invest $3.5 billion in Intel. Congressional aides say the money will fund advanced chip production for military and intelligence programs. That program will run over 3 years. The money came from a spending bill that the House passed yesterday, which Biden is expected to sign in this week. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, sentiment souring for Apple.
For Apple, for instance, we think that if Huawei really comes back to where they were in 2020 and early 2021, there is downside to expectations for Apple this year.
We will catch up with Apple bull Dan Ives of Wedbush. We'll also talk about Tesla too. That conversation up next. Stocks this morning doing okay, positive by 0.2%. Doing okay yesterday as well, but doing okay even with losses on the big two again, Apple and Tesla. Under surveillance this morning, sentiment souring for Apple.
Huawei is coming back and Apple is probably going to lose significant share in China this year. For Apple, for instance, we think that if Huawei really comes back to where they were in 2020 and early 2021, there is downside to expectations for Apple this year. Maybe like a further 10 million unit cut or 5% for 5% of volumes. So there is a bit of downside, and it's a headwind on stocks.
Here's the latest. Questions mounting for Apple's progress on AI. iPhone sales plunging in China and renewed pressure from regulators in Europe and Washington. Dan Ives of Wedbush remaining bullish, writing this. We've been through many challenging periods in the Apple story, and we handheld investors through these stormy periods just like today. Brighter days will be ahead for Apple. They've got an outperform rating and 250 price target. Dan Ives is with us right now. Dan, thanks for being with us, sir. I know you're down under in Australia. You've just got back to there from a trip around Asia. Can you tell us, Dan, what you learned from there and just how big is the iPhone slowdown story in China?
Yeah, look, I mean, we're seeing clearly negative sentiment, not just on the street, but it's validated by the price cuts that we're seeing for iPhone. Look, I think it's a white knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle. And I believe it's all right now about AI. You do not want to be selling this stock into AI coming to Cupertino. That's why this is, in my opinion, not the time to throw in the white towel.
That's Apple, but it's not just Apple. It's Tesla too. And there's a slowdown in China as well. Dan, you've had a buy on the whole way down. The stock has been cut in half, cut by a third, something like that, year to date. I think we're down something like 29% so far in 2024. Dan, why is the thesis still the same for Tesla?
I mean, because I view it as that they're cutting prices. They're going to squeeze competition. And I think when you look over the next 6, 9, 12 months, they're going to go into the next phase of growth. I think margins trough out. Right now, I mean, I'd say sentiment is as awful as I've seen in 3 to 4 years. And on the other side, you have massive earnings power that's ultimately going to be driven by more and more volume, plus the AI story that comes to Tesla. And I think, look, my whole point is we've been through this many times in Apple, many times in Tesla. And clearly the bears are piling on for good reason. But this is not the time, in my opinion. I think it's just the middle part of the next growth phase in both stories.
So when you talk about the AI story coming to both, and I want to start with Apple, there's a real question of whether they'll be late to the party, right? I mean, this idea that they're going to push right now into artificial intelligence just a couple months before Samsung is set to release their artificial intelligence infused phone. Are they too late? Are they still really immune to true competition?
Look, I don't think they're too late because there's 2.2 billion reasons they're not too late. I mean, that's the install base in terms of iOS install base. And when you look at what Cupertino's been able to do again and again, it's monetizing that install base. And the services business continues to be rock solid. You combine this with now AI, not just coming to what I believe is the App Store, but AI functionality coming to iPhone 16. That 1-2 punch, I think that we look back at this was more of a golden buying opportunity than ultimately the time that Apple becomes a structural negative.
I think there are a lot of people who probably would be more sympathetic to that view than the one with Tesla, especially in light of Apple's own move to get out of their vehicle manufacturing effort. This is not necessarily the sort of container for all AI and for all of our hopes and dreams, the traveling living room and bedroom and office that a lot of people had expected. Why do you think that Tesla can win on artificial intelligence when a lot of people are saying maybe it's just a car company and the car business is hard?
And they've said that for a decade. And I think it comes down to when you look at Rivian and others, just how hard it is and what Tesla has been able to accomplish. I think this is a growth story that we are still in probably the second inning of where this is broadly going. They have $30 billion in cash. They're going to squeeze competition. And when you look over the next 1-2 years, you're going to have 3, potentially 4 new models. And look, has EV demand softened globally? Of course. But this is just them going through a challenging period onto the next phase. We will yet again be on what I believe a growth frontier for Tesla, even though clearly right now it's not roses and champagne, and we're navigating a very, very nerve-wracking period for investors.
I want to understand, Dan, where that growth is coming from, at least in the near term. Stateside, you're seeing the problems to such an extent that GM are considering hybrids because the demand for an EV pure play right now just isn't there the way they thought it would be. I'm thinking of a clear and obvious risk factor in China right now, Dan. As you know, the White House is looking at national security issues around Chinese EVs. Now, Dan, it's not unthinkable to imagine a world where the United States makes it almost impossible for Chinese brands to sell their vehicles into the US market. Dan, what do you think is going to happen to foreign automakers trying to sell into China if that's the way of travel for the US administration?
Look, it's a tightrope, no doubt. I mean, the Beltway, what they're doing, potentially on the China national security issue, it's a worry because of the retaliatory. And that's added right now, I think, to this black cloud over Tesla in terms of where that could go. But I do ultimately believe bark will be worse than the bite. And it comes down to Tesla is a trophy case within China as well. I mean, just given how they built Giga out there in Shanghai. So in my opinion, this is a piling on. There's clearly a lot of negative news, but I believe we get onto the other side as we look back, and it was just a bad turbulence phase, and the plane wasn't going into the ocean.
Dan, I've been racking my brain for a time when you were bearish on any of these names, and one of them was when Elon Musk bought Twitter, now X, and you worried about reputational risk. There has been still a lot being talked about with respect to Elon Musk. How much can you strip out Tesla and the hope story and the dreams from the volatility of Elon Musk?
Look, I mean, Musk is Tesla, Tesla is Musk, the hearts and lungs, right? And the genius of Musk, clearly there's a downside, as we've seen with X and some of the sort of circus show that was an overhang in the story. But I think investors are able to bifurcate. I think it's understanding now what Tesla's doing, what they've accomplished. Look, is X an overhang in terms of worries about selling more stock and some of the issues they've had? No doubt, it's a spider web. But if you look going forward, Musk, I believe, yet again will navigate Tesla through these growth challenges, even though right now, I mean, I'd say the New York City cab driver is bearish on Tesla and Apple because of these issues.
Hey, Dan, wonderful to hear from you. Enjoy Sydney. Fantastic city. Dan Ives there of Wedbush. Not jealous at all. I want to go to this story from Mark Gurman and Drake Bennett. Here's the headline. What a headline. How Apple sank about $1 billion a year into a car it never built. Yeah, basically, at what point can they use some of this insight and research and just translate it directly into AI, or how far back did it set them to try to jump on this idea that your robo-taxi and your automated vehicle was going to transform the way that you thought of life, right? I mean, I think people are rethinking the entire narrative around these, maybe prematurely, but that's the zeitgeist right now. Tesla in the pre-market down again, by the way. We're negative here by 1.4%. in early trading. Coming up for the second hour of Bloomberg Surveillance, Ed Yardeni of Yardeni Research, Tobin Marcus of Wolf Research, Herman Chan of Bloomberg Intelligence, and Christina Campmany of Invesco. From New York City, equity markets on the S&P 500 shaping up as follows. On day two, with Chairman Powell on Capitol Hill, your S&P 500 is positive by 0.2%. Yields are going nowhere. 4.0962% is where we are on the 10-year. A springle of economic data a little bit later. Jobless claims, the last big read read on the labour market going into payrolls tomorrow. Payrolls Friday just around the corner from New York. This is Bloomberg.
This is a very different Fed cycle because it's a recalibration of policy.
This is a Fed just sort of right-sizing policy, given the fact that inflation has slowed.
What measures are they willing to tackle from a fiscal perspective without, again, upsetting this economy, which remains still strong?
Essentially, what we've discovered is that there's an underlying resilience that just can't be ignored.
I think they want to cut rates, but I don't think they're in a rush to do it. And I don't think the economy is going to give them the excuse to do it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Bases absolutely loaded. We've got a fantastic week of price action lined up for you, given what's on the schedule. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. We've got a State of the Union down in Washington, D.C. Annmarie is in the nation's capital. We'll catch up with AMH a little bit later. Then we've got a trio of central bankers to talk about. At the Federal Reserve, Chairman Powell on Capitol Hill for day two. President Lagarde of the ECB, a news conference, an ECB rate decision coming a little bit later. And Governor Ueda of the BOJ. That BOJ meeting this month might not be boring.
There is now a 70% chance that people are expecting them to hike rates to perhaps zero. It would be the first move of that nature going back to 2007. And it raises this question of whether that will turbocharge or whether it'll put a damper on the rally of Japanese equities. Basically, does this give people more conviction that this is a new investment thesis and it is no longer the forgotten decades?
Certainly giving them some confidence to buy the Japanese yen this morning. Dollar yen session lows negative 1%. We've broken through 150. We're at 147.82. Let's get back to Chairman Powell. It's day two. The data has been fantastic in 2024, yet the message remained the same, even though the data has changed. And I often say, if your message stays the same when the world around you changes, then the meaning has shifted as well. The meaning of those comments is slightly more dovish than maybe a month or so ago.
When I listened to those comments, the meaning to me was that this is not a Fed chair that's worried about financial conditions easing. This is not a Fed chair who's concerned about the fact that we are seeing strong growth in certain pockets. This is a Fed chair that wants to cut rates and is going to do so, and is just looking for an opening to justify it.
Even with stocks close to all-time highs, credit spreads incredibly tight. Jobless claims, where are they? 215. Get jobless claims a little bit later this morning. 216 is the estimate. Put all the data together. The employment component of the ISM services read came in much softer. The ADP basically in line. I know you've got some thoughts on JOLTS, but a little softer there as well. All of this lines up just to say, OK, things are decent, but we're not getting those booming reports we got earlier in the year.
And we're getting that disinflation. It does seem like it's messy, but it's generally continuing down that trend. The data's been messy. It's been really tough to extrapolate.
It has been for a while, eh?
It has been for a while, and it feels like we're at some sort of tipping point, but we've been at a tipping point for about 7 months. So what does a Fed chair do with that? And what we have heard is basically they want to err on the side of preserving this economic cycle. And to me, that is massive and is part of what's been turbocharging this goal to kind of broaden out with respect to equity allocation.
Speaking of tipping points, NYCB in yesterday's trading, New York Community Bank, there was one point there where we're down close to 50% on the session, and you're really worried about the future of this institution. Then, boom, things change fast.
Worried about the future of this institution, not worried about the banking sector at large. In this story, to me, and please, you can send me your hate mail, but to me, this has moved from potential macro risk to sort of a more personality intrigue of who's going to run this, exactly what the policies are going to be around it, in a very idiosyncratic moment of U.S. rent control or New York City rent control. This is not the same story that it was a year ago.
The stock right now is just about positive in the pre-market, just off session highs. New CEO, equity investment from the former Treasury Secretary Steve Mnuchin. There's so many dimensions to this story. It's unbelievable.
Exactly. I mean, do you think that he's trying to angle for a policy shift? Do you think he's just trying to reprise his reputation?
Oh, I think if you do get a Trump administration, then maybe you probably are going to get a policy shift. But based on what we heard from Chairman Powell, he might be on board with that policy shift anyway.
Exactly. Why should you hold more capital if you can extend more loans? Again, there's a lot going on that suddenly gives this tailwind to banks more broadly in a way that a lot of people weren't expecting, even though typically if you cut rates or rates are lower, you would think that would be negative for banks that are actually extending loans. So watch the space, and JP Morgan will hit another record high.
It's why you've seen a series of all-time highs on the nation's largest bank. Equity futures right now on the S&P 500 positive by 0.2%. Here's the stage. It looks like this. Yields are unchanged on a 10-year, 4.1%. The euro going absolutely nowhere. That rate decision 1 hour and about 10 minutes away. 108.95. Coming up this hour, Ed Yardeni of Yardeni Research as stocks rebound on Chair Powell's testimony. Tobin Marcus of Wolf Research looking ahead to Biden's State of the Union. And Christina Campmany of Invesco looking for, quote, a few maintenance rate cuts later this year. We begin with our top story. Stocks rebounding after Chairman Powell reiterated rate cuts are likely at some point this year. Powell's position unchanged as a growing number of economists are forecasting no cuts in 2024. Ed Yardeni of Yardeni Research writing this. The stock market is having a significantly positive wealth effect on the economy. That's another reason to believe that the economy will remain resilient and another reason the Fed might hesitate to lower the federal funds rate for a while, maybe a long while. Ed joins us now for more. So, Ed, I wonder what camp you're in now, and thanks for catching up with us, sir, as always.
Sure.
Apollo, no rate cut this year. Mizuho, just yesterday on this programme, no rate cut this year. Where's Ed Yardeni and Yardeni Research on the same issue?
I'm basically in that camp. I think at most we'll get 2 rate cuts. 3 is possible, but at this point, I think those who are saying that rates may not come down have the weight of the evidence on their side. The economy is doing fine, as Chairman Powell said. Inflation's moderating. Why mess with success? Things are going just fine. And the notion that you have to bring the Fed funds rate down because inflation's come down and that real rates are going to slow the economy down, that's a debatable theoretical point.
Ed, you've made the point for a while now that you think this is going to be the roaring 20s. Does that thesis still hold? Why do you extrapolate this out, say, just beyond this year? Why do you think this has got a much longer runway?
Well, look, the economy is turning out to be remarkably resilient in the face of all the challenges, particularly the surge in interest rates. But I think what we really have seen is not just a tightening by the Fed, but also a normalization. Interest rates are back to normal, and the economy is proving that it can really handle it quite well. But the stock market really started to discount a roaring 2020 scenario on, I know the exact date. It was, we all know it. It was November 30th, 2022, when OpenAI introduced ChatGPT, and the excitement about AI has been extraordinary ever since then. So the stock market's already discounting that technological innovations, particularly AI, are going to increase productivity. And productivity is the fairy dust of the economy. It allows the economy to grow faster, inflation to come down, real wages to go up, and it's great for profitability.
Which is the reason why it was interesting yesterday that even though we got an overall index gain on the equity market in the U.S., you saw those big tech giants sell off just a touch. Mm-hmm. What does that tell you about where this rally is?
Well, I think I'm actually delighted to see that the market's becoming a little bit more discriminating in terms of the mega cap 8. I like to focus on the mega cap 8. Everybody else, I like movies, so I want to include Netflix in there. But if you want to just focus on the Magnificent Seven, so-called, they're starting to split off. Apple and Tesla are having some issues. NVIDIA still looks good. On the technology front, I think it's hard for me to see the technology stocks really getting hit hard here when on March 18th, NVIDIA is going to have a festival in San Jose, an AI festival. They're going to have a convention for a couple of days just extolling all these wonderful things that AI can do. And I think the market's going to get pretty excited about it.
I love this, Ed, that we're getting to the point of enthusiasm about AI, that they're going to hold a festival, and that will definitely fuel further gains. And you're probably not wrong. So that is where we are. I am wondering whether the thesis holds in that the rest of the 492 stocks in the S&P 500 can get that same tailwind of productivity and those other gains if the Fed doesn't cut rates, because these are the companies that arguably are more tied to them.
Yeah, and by the way, that is very relevant to the so-called real interest rate. And maybe the inflation-adjusted federal funds rate should be higher than just the past 10, 15, 20 years, because we're back in an environment where productivity is growing faster. And that means that the economy can, in fact, live with these level of interest rates. So, yeah, I think, looking ahead here, there's potential for the economy to grow faster than expected because of productivity.
As we look ahead, can we look back, Ed?
Let me, I didn't really finish.
I thought you had done. Forgive me. Carry on, Ed, please.
No. That's fine. I sounded like I finished, but I didn't. I just wanted to answer the question. Is that the stock market's been doing pretty well here. The notion that it's only been 7-8 stocks that have leading the way is absolutely true because they've been so spectacular. If you look at the other stocks, we have lots of industries that don't have any of these magnificent 7 stocks, and they're up 20% or more. So the breadth of the market isn't that stocks haven't moved. There have been plenty that have moved. It's just they haven't moved as fast as the big ones.
Wanted to finish on this, Ed, if we can. It's a question you asked yourself. As we look back, if this is the 1990s, is it 94 or 99? Ed, what was the answer to your own question?
I think it's December 5th, 1996, when Alan Greenspan, I think I got the right date, when Alan Greenspan gave a speech, and he said, how do we know if we have irrational exuberance? And I think everybody's asking that question right now.
I think we are. Not just you, Ed. Ed Yardeni of Yardeni Research. Ed, thank you, sir. Irrational exuberance. As people often remind us, it wasn't right at the tippy top of the equity market boom.
Yeah, and when you don't think that it is irrationally exuberant is often when it is. I do love this idea that the wealth effect is going to keep this going, given the fact that people are getting their equity returns. And it goes to what Sharon Bell said, which is when you're feeling good and you're getting stock returns, you go to Gucci, you go to Hermes. I wonder at what point this starts broadening out to some
You say
other
you
things.
go to, I mean, some people might go to Gucci. I'm not sure everyone does, but I take your point.
You have yours, everyone has theirs.
Jensen at NVIDIA has been more important to this equity market than Jay at the Federal Reserve has. It's got to be the takeaway of the last few months.
And the ramifications for that, and that's the reason, just to tie it full circle, the ramifications for that in the economy and the Federal Reserve in terms of inflation, it's telling that they don't think that it's a significant deal, that the financial conditions aspect isn't necessarily problematic in their achieving that 2% price target. That, to me, is really compelling and something I'm watching for today.
Fed Chair Jay Powell has said explicitly strong growth isn't a problem and basically hasn't really pushed back against what's happened in markets either. Equity markets close to all-time highs.
Which is the reason why, to me, the fact that person after person lining up and saying there might be no rate cuts this year is actually a sea change and raises a question of what is the new normal in terms of a neutral.
The list gets longer. So we've got Torsten Slok of Apollo, we've got Steve Raschuta of Mizuho, and I think Ed Yardeni there was kind of on the same page as both of them.
Basically, if you're looking for reasons to cut rates, you're not finding them in the data. He basically made that very clear, and the data is showing that a lot of these equities can keep rallying even with rates at these levels.
Equities rallying this morning. We're positive by 0.2% on the S&P 500. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Houthi militants claim responsibility for an attack on a commercial ship off the coast of Yemen. 3 crew members were killed. The rest abandoned the ship, according to British and American authorities. It's the first confirmed death of crew members since the Houthi attack started in November. Minneapolis Fed President Neil Kashkari says he might lower his expectations for Fed cuts this year. Back in December, he said he had projected 2, but now he says his forecast will show 2 or potentially just 1 when officials submit their new projections in March. NYCB shares higher pre-market by just 0.3%, so barely, but the struggling real estate lender rallied a lot yesterday after receiving an equity investment of more than $1 billion from investors that include the former Treasury Secretary Steve Mnuchin. NYCB shares have lost almost 2/3 of their value since the bank had slashed its dividend and set aside more provisions for expected loan losses. That's your Bloomberg Brief. John.
Danny, thank you. Up next, a pivotal State of the Union for President Biden.
We're better positioned than any country on earth right now, but we have more to do. But here at home, inflation is coming down.
That conversation up next with Annmarie down in Washington, D.C. This is Bloomberg. Busy morning today. Equities up by 0.2% on the S&P 500. ECB rate decision coming a little bit later on this morning. After that, you'll get jobless claims in America. After that, you'll hear from Chairman Powell for a second time on Capitol Hill. And then a little bit later, this. Under surveillance this morning, a pivotal State of the Union for President Biden.
We're better positioned than any country on earth right now, but we have more to do. But here at home, inflation is coming down. Here at home, gas prices are down $1.50 from their peak. Food inflation is coming down, not fast enough, but coming down. Inflation has fallen every month for the last 6 months, while take-home pay has gone up.
Why so angry about those things? Aren't they good things, Bramo? You'd think they would be.
It's energetic.
Are we getting angry Biden later?
Your anger is somebody else's energy, maybe.
Your pay's gone.
I know. We'll discuss it, I'm sure, tomorrow.
It's the latest. Bidenomics is once again likely to be high on the agenda in the president's State of the Union address. The speech is a critical moment for Biden as he frames his pitch for the November election. The president planning to ramp up attacks on Donald Trump's economic agenda, circulating memos contrasting their agendas during this address. Annmarie is back with us down in Washington, D.C. AMH, just to pivot slightly, I thought we would be starved of debates. Based on what we heard from the former President Donald Trump in the last 24 hours, he's ready to debate President Biden anytime, any place, anywhere.
Well, that's what he says. Remember, the former president would not get on a Republican debate stage when it came to the primary. But now that Nikki Haley has said she is bowing out, he says he's ready to take on President Joe Biden in a debate. What's interesting, Jonathan, is that the Biden campaign basically said, well, you can see what the president has to say. Please tune in this evening to the State of the Union, but didn't say whether or not they would accept that debate challenge. And they said, let's see how this cycle persists. A lot of people are talking about, would we even see these two take a debate stage? Potentially we will. And the former president said he's ready for it.
What are people in D.C., where you are right now, saying about just how President Biden faces a much higher bar right now with this State of the Union and just in general, in terms of his delivery, in terms of his policy projections, in terms of, exactly every aspect of his performance?
Well, people are billing this as the most important speech he will give of his presidency, and potentially it could be his last State of the Union if he is ousted in November. And given the polls continuously show that Americans are very concerned about his age, our swing state poll shows 8 in 10 are concerned about his age. The bar is actually for him to just make sure there's no gaffes. He doesn't bumble. Remember, the pressure is on Biden, given that special counsel report that says he's a well-meaning elderly man with a poor memory. He needs to make sure this evening he pivots to a well-meaning elderly man with a strong memory and that he's robust. And for that conversation, we should bring in Tobin Marcus, head of policy and politics at Wolf Research, who's been looking into this. Tobin, is this the bar for this evening, to just make sure that he comes out, that he can be an influential president up for the job at 81?
Yeah, certainly the thing that has gotten the most scrutiny is the question of performance. The delivery in last year's State of the Union, Jonathan just characterized as angry, but, I think we will see something very energetic. I mean, last year's State of the Union, for what it's worth, I think did go pretty well from a performance perspective. He famously got into sort of mixing it up with House Republicans on the question of entitlement cuts in the sort of early stages of the debt ceiling debate at the time. If they can manage to engineer another sort of organic moment like that showcases some nimbleness and energy and sort of quickness on his feet, I think that would be ideal for them. But short of that, I think just a crisp delivery that shows some energy and, to your point, sort of free of any notable flubs. And then, of course, there's the policy content of the speech where, I think that this very much is going to be teeing up a proactive contrast between Biden and Trump. I think the Trump folks, the Republican Party more generally, is shifting into a kind of are you better off than you were 4 years ago mode. I think that the Biden campaign needs to and is going to reject that frame and instead try and make this a contrast of proactive priorities and values, sort of who's fighting for whom, and positioning Biden and the Democratic Party as fighting for the middle class and going after the rich, hence the rollout of kind of progressive policies that we've seen in the past 24, 48 hours.
You write in your note that you, unlike a lot of cynics, don't think talk is cheap, that a lot of this can translate to policy. The issue that comes up for policy with Biden and Trump is the extension of the Trump-era tax cuts. Regardless of who wins, we will see some extension at some level, correct?
Yeah, absolutely. So We have about $3.5 trillion worth of tax cuts that are expiring at the end of 2025. The 2017 Trump's tax package made its corporate and capital gains tax cuts permanent, whereas the individual and pass-through tax cuts were largely temporary, expiring at the end of next year. In any kind of a divided government scenario, I think probably what we're going to see is extension of the tax cuts below $400,000. That's what Biden's proposing. They're going to reiterate their no new taxes under 400 pledge in the State of the Union tonight, and it's something they do take pretty seriously. That's about $2 trillion of the $3.5 trillion footprint. And then in the Republican case, I think they will be trying, like in a Republican trifecta, if we have Trump and a Republican House and Senate, I think they'll be trying to extend all of those tax cuts wholesale. And the question then is, what gets cut in order to help pay for those, or what other revenue sources get brought in? And I think that's, there are a lot of questions on that front that will determine, sort of much of how next year goes from a market perspective.
We're also expected to hear Biden talk about raising the corporate tax rate, about raising the rate when you buy back your own shares if you're a company. But I take issue with the fact that the Democrats had control at one point early on in the Biden administration of full control of Washington. Why couldn't they make these moves then?
Well, the two-word answer is Joe Manchin. The original version of their big fiscal package in 2021, what was then called the Build Back Better Act, the sort of early version of their reconciliation bill, did include a lot of those corporate raisers and raised multiple $1 trillion worth of revenue with, a grab bag of Democratic priorities going after both high-income individuals and corporations from a tax perspective. That package, of course, got stripped way down in terms of its content. The social spending was largely stripped out. The climate spending was kept in. And so there was less need to pay for them. And they ended up with this sort of rump set of Democratic revenue proposals that Manchin and Sinema were happy to get on board with. So, for example, they included a 1% tax on buybacks. Biden's now proposing to take that up to 4%. So, there's lots of ideas that, Biden's happy to go for, but that Manchin was not. But, holding even 50 Democrats together in the Senate, I think, was somewhat of a surprising achievement. In retrospect, it's not terribly surprising to me. They didn't manage to get their entire laundry list of tax increases done.
When the president's budget will be coming out, our colleagues are reporting, John Schwingrove, that Biden's budget got a touch more optimistic after NEC Director Lael Brainerd is pushed for and won a slightly lower interest rate when it comes to the 10-year. Do you think this will resonate with the American people, or they just say you're playing politics with your budget?
I don't think that is something most voters are going to notice. It is certainly a tried and true game to kind of manipulate baselines to try and make those budgets look better. Of course, in the Trump administration, there are all these debates over kind of long-term growth forecasts and the extent to which, budget projections relied on unrealistic expectations about growth. From Brainerd's case, I'm sure it reflects some level of kind of sincere, descriptive view about what is likely to play out, in addition to the kind of obvious politics of it. But I would be very surprised if any ordinary voter paid much attention one way or another to what the kind of out-year deficit projections from the White House are showing, particularly given that the sort of independent projections from the Congressional Budget Office, I think, tend to be more of the focus of discussions about this in Washington. The sort of OMB numbers that we're talking about here in the president's budget are, and kind of important input into that debate, but ultimately, I think not an enormous focus.
Tobin, thank you so much for your time this morning. Tobin Marcus of Wolfe Research. Jonathan, his point early on, they might want to try to have a situation where Biden is actually having a row with some Republicans on the House floor, because that was a memorable moment last year.
Interesting. AMH, thank you. Appreciate it. Annmarie down in Washington. We'll catch up with AMH a little bit later. Love this story on Lael Brainerd. Pushing for a forecast with lower interest rates. Can we just go back to the last forecast? Great write-up from the team here at Bloomberg. The 10-year Treasury forecast in Biden's first budget predicted a rate of 2.1% in 2024. 2.1% on a 10-year compared to where we are right now, which has a 4 handle.
Exactly. Just to put this into perspective, I love the statistic. A reduction of 0.1 percentage points in the forecast rate equates to a savings of $300 billion in the deficit over the entire 10-year projection. It's not small math.
There's kind of an incentive to say, sort of, I think this is going to be a little bit lower. Yeah. Equities right now on the S&P, positive by 1/3%. Up next on the programme, New York Community Bank receiving more than $1 billion from former Treasury Secretary Steve Mnuchin's firm. That conversation up next. in just the last couple of minutes, just a little bit of news, a clarification coming from NYCB. We'll get to Bloomberg Intelligence's Herman Chan in just a moment to break down the details. In the meantime, equities look like this on the S&P 500. Session highs up by 1/3%, doing okay, positive by 0.5% on the Nasdaq. Lots to talk about in the bond market. We've got to talk about the economic data. Here's the 2-year, the 10-year, the 30-year. Yields going nowhere across those three maturities. 4.56 on a 2-year, 4.10 on 10s, on 30s, 4.23, 41. The economic data later. Jobless claims. Jobless claims, last time we got them, 215,000. The estimate, 216. If you want a sneak peek of payrolls tomorrow morning, here is your sneak peek. 200K is the estimate in our survey. You all remember the blowout January jobs number. That was 353,000. Unemployment, looking for that to stay at 3.7%. Average hourly earnings, whatever they're worth, Bramo, looking for them to come down from 0.6% to 0.2.
And we're looking for average hours, worked to come down to 34.3 from 34.1. So actually to increase. This to me might be the most interesting, and I'm bungling it up. It's like I'm so excited I can't handle it. But basically, if you see an increase in hours worked, does that mean that companies aren't cutting back on the edges to sort of avoid having to lay off workers? True. Is this something that sort of, I don't know, shoves away this thesis on labor hoarding?
This time next week, we're going to have a lot of data in hand. By the time you get to this time next week, we'll be looking for retail sales later that morning. We'll have CPI from the day before. You'll have payrolls on Friday. A much clearer picture of how things have developed so far this year. Let's turn the page to foreign exchange. We want to talk about the euro. We're going to catch up with the ECB a little bit later. A decision from them in about 44 minutes' time. The euro is totally unchanged going into that decision. 108.99. Some forecasts from President Lagarde as well, and a suggestion from Simon French and Annmarie Hordern that when you get that inflation forecast for the near term, it might be revised lower, which opens the door for him at least for this ECB to go before this Federal Reserve.
You know, I'm laughing because the ECB is the most non-event of today, and it might not be, right? But people don't even want to talk about it. You know, they're sort of saying, do we have to parse through this? There's going to be disagreements. They're not sure. I mean, to me, it's sort of fascinating how this has become such a less relevant story than the Federal Reserve and what happens there. It seems like people have less optimism about the ECB and less of a debate there.
Would you like to talk about the BOJ? We can do the BOJ.
I think the BOJ is really interesting.
Dollar yen right now, breaker 150, price action for Bramo, 147.88. We're negative on that currency pair by 1%. That is some real yen strength. In fact, the strongest day for the Japanese yen so far this year, off the back of a couple of stories here at Bloomberg. And if you are just joining us, I'll go through two of them for you. So one story from BOJ officials, according to that story suggesting that maybe those officials are gaining confidence in the wage data that's coming through, better than expected. The second story coming from government officials suggesting they're OK with the idea of a near-term rate hike. So everything's just coming together for Japanese authorities to hike rates.
Which is a reason why the market's pricing in almost an 80% chance of a rate hike. I mean, they're going rate hikes. Everybody else is going rate cuts in the March 18th to 19th meeting. Key question for me is, what does this indicate? Is this beginning of something more significant, or is this just basically kicking it up to 0.25% to basically herald in this new era of more growth, a little bit more inflation, and frankly, a much better investment thesis for a lot of different investors?
Do you remember I called it Operation Ostrich? When all the other central bankers were sort of scrambling around, inflation surging, they want to hike interest rates. It was head in the sand in Tokyo. Head pops out. It's like, we need to raise interest rates maybe this month.
Although Operation Ostrich worked.
I know.
I mean, that's the thing is that, you know, people, and myself included, I can have as much snark as I want.
Sure.
But the bottom line is, it's been working. And something is going very right for that economy. And a lot of people are betting with their money.
Oh, it was a gift. It was an absolute gift. A multi-decade effort to get inflation expectations higher. And then we had this global inflation story take off, which they were just like, bring it on. And everyone else was like, no, thank you.
Yeah, but they've done it in a way that's given people real optimism. And to me, I wonder how much this is the China story, too, people shifting away from China and looking elsewhere. Either way, I am really interested in this meeting.
Dollar yen, 147.84. Bramo's on board. Under surveillance this morning, President Biden delivering his State of the Union address at 9 p.m. Eastern tonight. Biden looking to convince voters he's prepared for a second term by touting his economic agenda and attacking former President Donald Trump's. He's also looking to reassure voters who have concerns about his age and mental acuity. And it's the last point I know which frustrate you, Lisa, because a lot of the reviews of this State of the Union is going to be about how energetic he is later on this evening.
And frankly, I'm not interested. Like, on one hand, sure. But on the other hand, I want to hear policy because it's the people around him that also are going to push it through. And the question is, what can he do given the fact that there are certain caps in how much he can spend? Where does he shift around spending? We heard about some of the defense spending that he's going to be doing. How much does he talk about that versus lack of substance if we go back into character assassination on all sides? To me, again, it's sort of from a market perspective, I want to understand the meaning.
Yeah.
For trade policy, what do we want with our allies? What do we want with our adversaries? I want to understand about tax policy, and I want to understand about the deficit. And those things putting together, we're probably going to hear none of that. So, we'll be talking about, different things.
If you want a policy conversation, look to day 2 of Chairman Powell today. How's that?
Then very good.
On Capitol Hill, after reiterating the Fed expects to cut rates at, quote, some point this year, and answering questions from the House Financial Services Committee, Powell will face the Senate Banking Committee at 10 a.m. Eastern Time. The Fed chair has also faced pressure from members of that committee, including Senators Sherrod Brown and Elizabeth Warren, urging him to cut rates sooner. So there's Senator Warren. Sent him a letter at the start of this year saying cut rates, cut them now. I imagine she's also got thoughts on his comments from yesterday on financial regulation, which was really the headline from yesterday's testimony.
It was the news, right? The fact that they're considering overhauling a proposal to have big banks increase their capital withholding by 19%. Do you enjoy these hearings?
No.
Okay. Do we learn really anything substantive?
Very little.
So the fact that we actually broke news yesterday is interesting, the manner we could parse through that. The grandstanding, et cetera, it really raises this question, what are we hoping to accomplish here? I mean, not to be too, dismissive, but what are we hoping to accomplish here? This is kabuki theater. I keep going back to this. Everyone wants to get up and say their thing.
What are we going to accomplish? A 2-minute campaign video from the senator from Massachusetts on bank regulation. That's coming up a little bit later. Let's finish on banks. New York Community Bank getting a lifeline. The struggling lender receiving over $1 billion of equity from investors, led by former Treasury Secretary Steven Mnuchin and his firm Liberty Strategic Capital. The bank also naming former comptroller of the currency Joseph Otting as its new CEO. Otting replaces Alessandro Di Nello, who was named CEO just a week ago. Herman Chance, senior US regional banks analyst for Bloomberg Intelligence, joins us now. So, Herman, a bit of news in the last few minutes. They called it a clarification of yesterday's news. What is that clarification?
So they gave more details on the transaction and the dilution that the transaction will bring. So basically, the numbers look a little bit better for existing shareholders, about 41% ownership stake for the investment group, which is a little bit lower than what we expected from the news release yesterday.
What are they buying into? What is this now?
So it's a vehicle for them to improve the balance sheet. It's a $100 billion asset organization. So it's in the big leagues. And the investor group, specifically Steve Mnuchin and Joseph Otting, this is the same playbook they used with the IndyMac takeover after the financial crisis.
They like catching falling knives, and this was a falling knife, which raises this question: how quickly was this transaction solidified yesterday when it seemed like these shares were falling out of bed?
Yeah, it seems like it came through pretty quickly, and I'm sure there were last-minute negotiations on pricing once the stock was halted and the stock was in a free fall. So it's great that the bank was able to get a lifeline and inject capital and potentially improve the reserve.
The IndyMac question is really an interesting one. And we've been talking about it all morning. What does Steve Mnuchin want with this bank? Right. Considering that there were some accusations of predatory lending or certain difficult policies with respect to their mortgages at IndyMac. With this transaction, where is the value creation going to come from?
Yeah, it's going to be a turnaround story. So they have a blank slate to really change the narrative, grow the portfolio, improve the credit quality. But the thing that really comes back to is this is a very big organization, and IndyMac was much smaller when they sold the institution to CIT. And as such a large organization, is there going to be a willing buyer later down the road when they fix it up?
So they've got exposure to loans on buildings where effectively you can't put the rents up.
Right.
How do they change that?
Yeah.
Because that sounds like a policy issue.
That is going to be the big narrative going forward. Maybe it's a coin flip on the potential Trump presidency next year. And maybe there's some sort of, as a cynical viewer.
Let's get into it. No, let's get into it. Because Lisa raised the question. You think there is the potential here that this is a bet on a shift in policy? And do they have the authority at the federal level to make that shift?
I think that's something that probably is in their mindset going forward. remember, the OCC is the agency that is regulating them. And if there is a change in presidency, there could be a change in regulatory posture and could introduce some more lax regulation going forward.
Just to frame this, where and how much value is there in this bank without some shift in regulation?
Right. The market's telling you that right now it's trading at, based on the updated tangible book value, it's about half of tangible book value, which is about versus 1.1 times, 1.2 times the group. So it's still in a very distressed situation, but it does offer a lifeline for improvement going forward.
I'm glad John brought up whether this is a local or whether this is a federal issue, especially at a time where it's not just New York Community Bank that's dealing with it. We heard from M&T Bank yesterday, for example, with some of their rent-controlled related loans. How big of an issue do you think this is, not only from a monetary standpoint, but also from a property ownership standpoint, both in the banking industry and outside?
Yeah, well, the issues are really specific to New York Community, where they are the biggest player by asset concentration in the rent-regulated multifamily space. So it's less of a dire situation for a lot of the other banking institutions. And we're talking about like 20% of their portfolio is rent-regulated for New York Community currently. So any potential dings in their credit quality will really affect them, whereas the other regional banks are much more diversified.
I believe it's anniversary week for the failure of SVB, which is not really an anniversary anyone wants to celebrate. But Lisa's mentioned this a few times. In fact, we both have. The fact that JP Morgan's trading at record highs, the fact that the rest of the regional banking industry, just in terms of the stock price, isn't being pulled down by what's happening by the likes of NYCB. How much progress have we actually made in the last 12 months?
Yeah, I think you can see by the stock reaction over the past few days across the group where it has been very much an NYCB specific issue. And we've heard a lot of encouraging comments from the bank management teams over the current conference cycle this quarter, where everybody still feels very sanguine about credit quality, and we're muddling through all the issues.
Hemant Chand of Bloomberg Intelligence, thank you, sir. NYCB in the pre-market looks a little something like this. We're just negative by 3.5%. Keep an eye on that. Lisa, last year was about rate issues and mismanaging your rate exposure. It's the credit risk story that Herman's talking about. Can we really go through this cycle without credit issues? Can we really go through this cycle without any?
That's what I want to ask Howard Marks. Basically, if you talk about the exuberance that low rates created for so long, well, where are the zombies getting blown out at this point? Where do we see some of the sort of naked people when the tide rolls out that are exposed, right? Because this was what everyone was warning about. And why are we not there? And so this is really the key question. And right now, people are shrugging it off. This maybe is one of the naked people in terms of rent policy, although maybe Steve Mnuchin has an inside ear on how to change that.
Possibly. Howard Marks of Oaktree joining us in about 20 minutes' time. Do not miss that conversation. He's going to be with us for about 30 minutes. He'll react to some of the ECB decision as well. So looking forward to that. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump wants to debate Joe Biden. The former president posted on Truth Social, quote, "I'm calling for debates anytime, anywhere, any place." Trump had skipped the debates during the Republican primary. A Biden campaign spokesman says that if Trump is desperate to see the president in prime time, he can watch tonight's State of the Union. A March rate hike may be in the cards for the Bank of Japan. Bets for the month are gaining traction. There was stronger wage data and BOJ official comments to that effect. The yen is strengthening, blowing past 148 per dollar. More insiders are unloading NVIDIA stock. Two directors recently sold $180 million worth of share. NVIDIA closed at another record yesterday with a $2.2 trillion market cap. It trails only Apple and Microsoft in the S&P 500. And that's your Bloomberg Brief. John.
Danny, thank you. Up next, Chair Powell, sticking to script.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates.
That conversation coming up next, live from New York City this morning. Good morning. Big 60 Minutes coming up. Bit of data in the next hour. Jobless claims, central bank decision as well. ECB. You'll hear from President Lagarde in just a moment. Euro-dollar 108.99. President Lagarde about 60 minutes away. In the bond market, yields a little bit lower. The emphasis on a little bit. 4.1%. on a 10-year. And in the equity market, we're positive here by 0.25% on the S&P 500. Under surveillance this morning, Chair Powell sticking to script.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. When we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Here's the latest. Chairman Powell facing the Senate Banking Committee on Capitol Hill, 10 a.m. Eastern Time, after reiterating the Fed's stance on rate cuts in front of the House yesterday. Christina Campmany of Invesco writing this: we can only look for a few maintenance cuts by the Fed this year and next year. The outlook for monetary policy and the economy broadly will be significantly affected by the election. Christina Campmany, I'm pleased to say, joins us now. Christina, good to see you. Before we get to the politics, it sounds like you're kind of on the same page as the likes of Apollo and Mizuho, who were calling for no cuts this year. Why do you think maybe it's just one or two in 24?
Look, I think that the Fed is still, we know that DM central bank policy, next step is easier. And I think Powell said it yesterday. We want to do that. They just seem to have this confidence issue. And it's not that we need better data, it's just we need more of it to have more confidence. So we still are in the camp that they ease 2 to 3 times this year. And I think beyond that, so much will depend on what the election outcome is and where we are kind of growth-wise.
What are maintenance cuts? What's the difference?
I think it's what we were talking about when we got the signaling, what we thought was a clear signaling message from Powell in December around we've reached restrictive rates. As inflation comes down, we are able to make maintenance cuts to get off restrictive. We don't need to get to neutral. We don't need to go through neutral at this point, but we don't need to be as restrictive as we once were.
I'm so glad you asked that. I was thinking to myself, is it like a trim rather than going in and actually getting some sort of style shift? I'm curious, Christina, we were talking about this earlier, and we're going to talk about this with Howard Marks coming up. What does this mean in terms of where real rates should be, given the fact that we haven't seen more distress? Does it really mean that all these companies with over-leveraged balance sheets that we all said that were zombies are just fine now?
Well, I think if you look in the last year and a half, since the fall of 22, the street has had these rolling forecasts for recession. I know that's something that we've talked about a lot of times, and it doesn't materialize, and we continue to have stronger U.S. growth. And this U.S. exceptionalism story keeps coming back. And we can't, again, across the street, these economists and policymakers are all having trouble contextualizing why is the U.S. economy so strong. So I think that it comes back to that. So we don't have a broad recession. It's hard to see signs of that. You have pockets of weakness and pockets of concern. Markets are concerned about private credit. Markets are concerned about the regional banks. But none of these are systemic issues at this point.
Well, this is the reason why, and John's brought this up, and I think it's a really important point. The leverage right now, where is it, right? The leverage is in the U.S. government. Mm-hmm. That people are talking about fiscal stimulus still being pumped into the economy. Is there going to be a price to pay for this? And I know I may be getting over my skis saying, is there going to be a Liz Truss moment? But is there going to be a Liz Truss moment?
I mean, again, when we look at rate markets and government debt, especially in the U.S., we come to that conclusion. It's really hard to see value in 10-year and longer Treasury bonds because we're not pricing in. The market has continued to give incredible trust to the Fed and its control of inflation and in faith of the U.S. government, right? Like, we are at 4% when you have recessionary fiscal type spending, and the only certainty that we have with whoever wins the White House is that you probably have more fiscal. So should it be more of a concern? Should we have a steeper curve and higher long end rates? We absolutely think so.
Your words, the economy and the outlook for the economy will be significantly affected by the election. Why significantly? What is it about this election that's so significant to you and the economic and monetary policy outlook?
I think, again, you may have more of the same from Biden, but we're at extremes in terms of fiscal and the spending and immigration. Again, going back to this growth in the context of U.S. growth and why it's been so strong, the immigration numbers have been a large driver. Now, is it a catch-up from COVID years if you didn't have immigration? Is it a broader trend? Is it something that sticks? I think we're at this precipice of what has driven the resilience of U.S. growth And again, from a policy, are we going to close our doors even more? Does that drive then regionalization and a preference for LATAM? You know, like all of these trade tensions. I think there's a lot of things that will drive the economy and how we think about the world.
These are all thought exercises right now. Are they driving active decisions currently for you and the team?
Again, I think it's hard to sit here and say, what is the Fed going to do? What are policymakers going to do in 25? Because so much will depend on this. Is it thinking about how we invest in markets? It is. And I think it also forces you to think, what are some of the tail trades or positioning that you need to consider in the risk scenarios? And it feels like the risk scenarios it's extreme. It's not we stay the course or...
Which raises this question about what you said about longer-term treasuries and that you don't like them because of exactly this. So where do you go for that ballast at a time where you're seeing incredibly tight spreads in credit and where arguably fiscal stimulus, if it's continued, means actually probably growth will be pretty good?
Mm-hmm. Yeah, look, so again, when we look at the rates market, and it feels like you speak to fixed income investors over the start of the year, and it feels there's a lot of turmoil, and it's been this brutal repricing of Fed policy from 125, 140 basis points of easing to this now swing of people talking about not easing at all, and you've had that whipsaw. Yet risk assets have traded exceptionally well and have lived in their own world. And we've said perpetually in the last few months, look, credit looks rich to us, and equities look rich. However, the backdrop allows the rich to stay rich or get richer. And I think there's this like push and pull. You've had record IG supply to start the year. January's record month, February's record month, March is exceeding expectations, yet it has been digested with ease. So is there a point that there's a breaking point? So when we look at things, we're barbelled. There's some value. We have comfort in being in the front end in higher quality corporates. We are okay with, again, having a curve bias, a curve steepening bias that like we'd rather own front end paper and 2-year paper than extend and have that duration risk.
How crowded are these trades?
I think trades are, again, the consensus trades are crowded and are getting more crowded. And I think the conversation earlier about the BOJ is one of them. People are very excited about the BOJ going again, but we've seen this playbook before, and there's reason to believe that this may be the time that the BOJ engages. But I think it's a well-subscribed view.
Maybe, possibly. Everyone's on board right now. Dolly Yen with a big move in today's session. I want to finish on what we heard from Chairman Powell just yesterday, not on monetary policy, but on financial regulation. Was that a green light to keep buying the banks?
Look, I think that regulation broadly, it's been something that has been topical, and there's been so much work for the GSIBs to support that. And I don't see a pull away or a reason for concern there. Again, when we look broadly at the consumer and at growth, and I think there's a lot of diligence on the bank side from a risk perspective. So I think the financials are well supported.
That's what I'm trying to get into. JP Morgan at all-time highs on the equity side of things. When you back away from a capital proposal like the one that was on the table in the last few months, does that do anything on the debt side of the equation for the banks at all? Does it make it a better investment proposition or not?
Look, I think that the financial sector as a whole is sound, and I think that the regulations that are always proposed seem to be proposed more stringent and then dialed back. And I think that leaves the market in an okay place to digest it from where we are.
Christina, good to see you. Christina Campmany there of Invesco, following Chairman Powell day one. Day two coming up a little bit later. The next hour just absolutely stacked. I'll go through it for you. We're going to catch up with the brilliant, the legendary Howard Marks of Oaktree, Michael Gapin of Bank of America, Democratic Representative Abigail Spanberger of Virginia. All of that still to come, Bramo. Next hour.
I'm so looking forward to that at a time where there's so many uncertainties and so much of it is sort of confluence of the political with the markets. With Howard Marks, I want to really talk about what it means to be in a new regime of truly higher benchmark rates, right? How do you calibrate risk where there's no alternative with people going into risk because they don't want to go into the alternative, right? I mean, this is sort of a new era of risk-taking when we haven't fully flushed out the old one.
The memo that came out at the start of this year, and there are many highlights in that memo, but one of the standout lines in there, rates aren't that high. Rates aren't that high. That's quite a line.
basically saying, look, you go back to the other eras and you saw much higher. Also talking about the potential he sees rates kind of 3 to 3.5% over the next decade. How does that reset everything when you start looking at a lot of capital structures? Again, are we talking about long and variable lags, or did the monetary policy just not matter?
You know when you get to the gate or you come out the gate at the airport and you get on those walkie things that make you go quicker?
Walkie things, yes.
What are they called? Like travelators?
Well,
what are they called?
Moving, yeah.
The people mover? Is that
I don't know. That basically, it doesn't make you
them?
actually a better athlete, that you're going faster.
That's the era of easy money. I love that.
I do too.
I love that.
Moving walkway.
There we go. That's next.
What is performing right now in this market are companies that are putting up good numbers on earnings, that have been raising guidance, and that have very strong fundamentals.
We are seeing more than just tech and consumer discretionary work well, so that's certainly a positive.
Yes, it's a bull market, but maybe more of a duck market.
We've been in this kind of environment that you can describe as benign, disinflationary Goldilocks.
We've got a market where inflation expectations are low, so why wouldn't you be happy?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The control room insisting it's a people mover still.
It's a moving walkway.
It's a moving walkway.
But if you want to call it people mover, go for it.
I'm going with Team Bramo. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures positive by 0.25%. Big 60 minutes coming up. Allow me to frame the next 30 minutes or so. In about 15 minutes, we'll get jobless claims in the United States. In about 30 minutes. In 15 minutes, you'll get the ECB rate decision. President Lagarde, 30 minutes after that. So it's a big hour in the next hour.
What's interesting to me is that we're not talking about Christine Lagarde at all. Right now, the question of when they cut rates by 25 basis points is less relevant than bigger picture questions around fiscal policy, which we're going to be getting, but also this idea of the economy and whether the jobs market really is as robust as people think.
Well, let's talk about the economy. 216 is the estimate for claims in 29 minutes' time. ADP was a little softer for whatever the ADP report is worth. Looking at payrolls on Friday, the estimate is 200,000. Everything just feels in line and OK at the moment, not boomy like it was in January, which I guess is sort of OK for Chairman Powell as well.
Yeah, it's very difficult to understand OK. That's actually something that I was thinking about. It's really good to identify boomy or busty, but OK, is it going to tip into one place or another? What do you do with OK? This is something I've been struggling with the data coming in. OK, tipping a little this way or a little that way. Where do you get conviction at that point?
Kit Jukes of SocGen has this to say. Wait for tomorrow's payrolls figures. If they're weak, I'll be more inclined to see the strong data for January as a curveball. If they're strong, I'll expect forecasters to rethink the Fed all over again. That was why the February data was always going to be important. Does it double down? Does it reinforce what we heard at the start of the year?
And what are the revisions like? That's something else that people keep talking about. They come up with projections, then you get the revisions, and then they got to completely reassess. It's a tough market to get right. The anecdotal data, again, it's OK. It's not boomy. It's not busty. At this point, where do you get conviction?
Equity futures right now, OK, not boomy or busty. I'm going to use that all day now. Equity futures right now positive by 0.2%. Here's a flavour of financial markets for you. In the bond market, yields a little bit lower by a single basis point, 4.09%. It's Chairman Powell, day two on Capitol Hill, yesterday in front of the House Financial Services Committee, a little bit later on this morning in front of the Senate Banking Committee. In the bond market, then, yields basically unchanged, down a single basis point or so. In foreign exchange going into that ECB decision, 108.94 on euro dollar, just a slightly weaker euro, slightly stronger dollar. Coming up this hour, the brilliant, legendary Oaktree's Howard Marks on why we're unlikely to see a return to easy money anytime soon. Bank of America's Mike Gapin looking ahead to the payrolls report, and Congresswoman Abigail Spanberger previewing the State of the Union. AMH down in Washington, D.C. We'll catch up with Annmarie in just a moment. We begin this hour with our top story. No news is good news. Stocks edging higher as Chairman Powell tells Congress he's expecting rate cuts this year, even as a strong economy keeps the Fed on hold for now. Oaktree's Howard Marks writing this in his latest memo. I find it interesting that the current stock market rally began as a result of optimism powered by consensus thinking that was generally off target. Investors motivated by their belief that the Fed would pivot to dovishness and start cutting rates in 2023. That was wrong. We'll get into consensus in just a moment. The legendary Howard Marks joins us around the table. Howard, good morning to you.
Good morning, Jonathan.
Fantastic memo. Really enjoyed the read earlier this year. Easy money. You reflect on the easier times fueled by easy money, lulling investors into a false sense of intellectual superiority. I want to know, and I think Lisa wants to know too, have we fully realised the pain associated with some of the loans, some of the things we did 10 years ago?
No, clearly not. It's early.
The economy is still good. That keeps shaky loans aloft. The maturities, any company that was not asleep at the switch pushed off its debt maturities in 2021, 22, when rates were still close to zero, pushed them off. So the maturities start for real in 25. There are not substantial maturities this year. And, there are three ways you can default. You can breach a covenant that specifies levels for your financial statements. You can fail to make an interest payment, or you can fail to meet a maturity. Well, the eager lenders let companies exclude covenants in recent years, so you can't do that. Interest rates mean that the coupons are low, interest coupons are low, so it's hard to miss one of those. And in a positive climate, you can borrow to make your interest payments. So we're really talking about maturities which have been pushed off to next year. And if you get maturities spiking in a weak economic period or weak for certain groups, that's when you get defaults. They're still running low.
A lot of people have come on this show, Howard, and said that this market is discerning. It's not necessarily just buying everything with abandon. It isn't exuberant. There isn't euphoria. There's sort of a separation of those zombies or those that are likely to default in 25 that can't survive until 2025 and those that can't. Do you agree with that?
I generally do. This is not... The crazy markets are few and far between. When you get a real soaring bull market, a bubble, or a crash, those are when they stop being discerning and, as we say, throw out the baby with the bathwater. Most of the time, markets are sane, especially a market like this, which is being buffeted by good news and bad news at the same time. So, yeah, I think we're in the middle ground. I've been saying for a long time that we're in what I call the zone of reasonableness, and I don't think there's anything much to do.
Zone of reasonableness, and I want to get into that there's not much to do, but a zone of reasonableness where there's a strong consensus, and you pointed to, and John led with, this idea that consensus last year was completely wrong. So this year, you said there's a feeling that smacks of Goldilocks thinking. How do you work with that as an investor?
Okay, I don't think the consensus is necessarily not wrong. I just think that most people can improve upon it. That's really the criterion. What I learned in school, the efficient market hypothesis, markets are efficient. That doesn't mean they're right. That just means that most people can improve upon the market's consensus judgments. So now tell me your question.
Well, I guess that I'm wondering, where are we in the cycle, in the credit cycle?
Well, following from Jonathan's question, Buffett says it best: when the tide goes out, we find out who's been swimming naked. The tide hasn't gone out. We're still in generally salutary period. Economy functioning well, earnings pretty good, interest rates coming down recently, money available. So under those conditions, you don't have a test. The question is, which companies and industries do okay when conditions get tougher?
Can we work through some of the more quotes in this memo as well? There's this great line, and you've said it's an old line, but I still love it. The worst of loans made at the best of times. Yeah. This quote from you: I love Hayek's word malinvestment because of the validity of the idea behind it. In low return times, investments are made that shouldn't be made. Buildings are built that shouldn't be built. Can we talk about buildings that were built that shouldn't have been built? Is that an area of focus for you at the moment as you think about prospective weakness down the road?
Well, I think that commercial real estate, office buildings in big cities in particular, are a focus area for investment people. The post-pandemic behavior of people not going to the office so regularly calls the sector into question, as does AI and the question of how many employees you're going to have. Or am I going to be talking in 5 years to a machine over there? I don't know.
Maybe you are right now.
There you go.
Maybe this is AI right now.
Lisa topped me as always. So I mean, there are questions about real estate. But on the other hand, most people won't touch real estate with a 10-foot pole, and they may be underestimating the intrinsic value. So that, Jonathan, it's important that everybody understand. The question is not, is everything going great in a sector or is it going terribly in a sector? The question is, do prices in that sector reflect the reality, overestimated or underestimated? I've made a living buying things that nobody else thought was a good idea, but if you buy them cheap enough, they become a good idea. And, if you have the right real estate in the right place, if you're differentiating and other people haven't, then that's a time for bargain hunting.
So you've got the story and the price of the story. Can I ask if you like the price of the story?
There's not a lot of price discovery going on in the real estate industry. There are very few transactions. So when you say, do I like the price of the story? I don't see a lot of prices. In order, I see, people say, it's not worth anything. But where will they trade? If the quoted price for a New York office building is down 50%, let's say, will any sellers sell there? Will all the buyers buy there? If a lot of people are willing to buy and nobody's willing to sell, that says to me the real price isn't down 50. So we have to have price discovery.
Which it brings us to kind of the fact that the tide hasn't gone out yet.
Exactly.
And that when the tide goes out, then we're going to start to get some real price discovery, because then there will be some people left naked. You don't like to make rate projections. You do have a model roughly in your head where you say in the memo that you don't think that rates are high. They're kind of more normal.
They're not high relative to my experience.
So if that's the case, you kind of game out a 3 to 3.5% Fed funds rate over the next 5 to 10 years. What then does that mean for returns just more generally? Does that mean that they're better in credit and better in your world? Or are they kind of worse because the overhang that we've had of the easy money policies is going to take a lot to work through?
Well, it's a complex question. But those, we're at 5.25 to 5.5 on the Fed funds rate now. That's a measure determined to crimp the economy, to kill off the excess inflation. The target is 2, we're above 2, cool off the economy until it moves toward 2. By the way, in Powell's remarks on Monday, he said, we won't cut rates until we see we're making progress toward 2%. I thought that the word toward was very important. He didn't say until we're at 2%. So I think that, if inflation starts going, 3, 2 3/4, 2.5, maybe he'll start cutting. I don't know. But the word toward was important. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 2009 through 21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, really paltry.
Howard, always super thoughtful. I'm pleased to say you're going to be sticking with us. We've got a central bank decision to get to as well, the brilliant Howard Marks. I want to get you an update on stories elsewhere too. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NYCB is offering new details after yesterday's equity investment of more than $1 billion. A statement says Liberty Strategic Capital and other partners are making individual investments rather than a combined investment. The bank will also sell nearly 60 million shares of common stock and 192,000 shares of a new series of preferred stock. Yesterday, NYCB raised more than $1 billion from investors. That included the former Treasury Secretary Steve Mnuchin. Congress may be taking another step to crack down on TikTok. Today, the House is expected to take up a bill that forces ByteDance to sell the app in 165 days. If it doesn't, the U.S. would ban TikTok from app stores. The Biden administration has backed the idea, but hasn't fully supported the exact legislation yet. The latest ECB decision is due in just a few minutes. Allianz chief economist Ludovic Sabran told me earlier on the brief that the central bank will find itself in a pickle this year if it ends up cutting rates before the Fed does likewise.
The big issue is what happens if the Fed doesn't cut at all this year. That's the big issue. And this would be horrible for the ECB because we're a financial obligé. Whatever happens in the US has to set the tone to what happens in Europe. There's not like, the ECB being all of a sudden, in the lead and not a laggard. We cannot do that. The financial flow risks are too high.
ECB President Christine Lagarde's news conference begins at 8:45 a.m. Eastern. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. An ECB decision just moments away. Breaking news just moments ago. ECB rate decision, no change to interest rates, but as expected, slightly lower in forecast for inflation. Mike McKee has the details. Hey, Mike.
John, it's actually a fairly steep reduction for the ECB, down to 2.3% for this year, as opposed to 2.6% in their last estimation. They also take down their forecast for 2025 to the target of 2%. 1.9% in 2026 as they're forecasting an overshoot. They're also looking to see growth slow significantly this year, just a 0.6 gain in GDP for 2024. And they expect growth to pick up a little bit, but only to 1.5% in 2025, 1.6% in 2026. This is the kind of numbers that we've been told to look for from Christine Lagarde when she starts talking about when they might cut rates. They may be ahead of the Fed because inflation's moving down more quickly and growth is slowing there. We got some bad news out of Germany today with their industrial production manufacturing down 11.3% in the prior month.
We've had tons of bad news out of Germany.
That's true.
On the continent. The euro right now is slightly negative on the session, 108.81. Just a programming note, that news conference will begin at 45 minutes past the hour. So we'll bring you the headlines from that ECB news conference in just a moment. We have around the table with us the brilliant Howard Marks of Oaktree. Howard, I want to start with this, and it's a question I know you're keen on answering. How relevant are these decisions? The ECB today, the Federal Reserve later this month, the BOJ, how relevant is all of that to you and the team?
Well, a year and a half ago, Jonathan, I wrote a memo called What Really Matters. And I started off by listing 5 things that, in my opinion, don't matter, the first of which was short-term events. So, if I tell you there are going to be 5 rate cuts this year, what will you do in your portfolio? And if I say, oh, no, it's going to be 3, what will you do different? If I say the first rate cut will come in May, what will you do? If I say July, what will you do different? And these things don't matter. They preoccupy us because, the real movie that matters runs so slow that people have to find something to do in the meantime. But, what matters is the direction of interest rates over the next 3 years, the direction of the economy, the growth rate. For me, as an investor, what matters is, do I lend money to companies that pay me back? Not what the profits will be next week or month or quarter. For the stock investor, it's are you investing in companies that will prosper over a multi-year period? That's what matters.
So I will just say that we do talk about it every day because we have to talk about something, and the slow-moving, sort of long-term story doesn't always fly when we're coming up with everyday news. But there is this question about when the cutting cycle matters in terms of going into Europe, for example. Does that affect your investment thesis if you have an ECB willing to ease policy in the face of real weakness, or are you just looking at strength and pockets of opportunity?
Well, that goes to the question of secularly, that is, over time, will the European economy be strong or weak? And it's clear that they believe that the growth over there will be quite anemic. That's important to know. Now, Oaktree does not make investments on the basis of macro forecasts. In other words, what we care about is, if we lend to a company, will they pay us back? Not what will GDP growth be in 2026, according to Mike, according to Lagarde. Look, Europe is weaker than we are here, and that's the important thing. Will that be realized? Will the expectations for the U.S. of I would say, more than 2 growth be realized? These are important. The other thing I know for sure is that I don't know. And, nobody at Oaktree knows more than the consensus about these matters. And that's why we don't make our investments predicated on these matters.
When you're going in, though, and you're looking specific company by company in Europe, do you see a lot of opportunities from companies that aren't as crowded as, say, in the U.S., where everyone's banking on the strength story?
Yeah, well, that's the other hand. You know, on the one hand, we know their economy is not as good as ours. On the other hand, maybe the investments are correspondingly cheaper. So that's why we can't. Nobody should invest on the basis of a single factor, like the rate of economic growth. It's always Jonathan's question: do you like the price, and do you like the growth rate and the price relative to the growth rate and the price someplace else? So that's if we earn our livings, that's how.
Can we finish on leverage and where we are in the cycle? This straight line in your memo, the mother's milk of rapid expansion and speculation. If we reflect on the last, let's say, 10, 14 years, you would imagine that in a decade-long period of ultra-low interest rates, you would have had this explosion in leverage. There are several reasons for that. But this period's been quite odd because we then had the pandemic, which led to the strengthening of balance sheets for both corporates and households off the back of a monster fiscal transfer. And a question I think that Lisa and I hear a lot, Howard, is where is the leverage now? Where is the leverage now?
Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had two serious problems: the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt. And you know, corporate balance sheets are generally okay. If you look at leverage buyouts, which is something that's very important to us, the leverage on those is lower than it historically has been. In the 90s, it was 70-75% debt, 25% equity in most companies. In the 80s, it was 95-5, and today it's more like 60-40. So the companies themselves are generally less levered.
Is it too simplistic to say if the increase in leverage has been on the sovereign balance sheet, that's where the risk is? How do you frame that? How do you think about that?
Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. They don't, when we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
And then they have the ability of extending the cycle at the same time. I think this is what I'm trying to get my head around. If they've absorbed basically the leverage that existed elsewhere, and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever, But and then the other question is, are the currencies acceptable to the world and at broad price? An exchange rate is a price. The dollar euro exchange rate is the amount of dollars that people will pay to get a euro. And if that goes off the rails, then maybe they can't print as much or have other indigenous problems. So again, multi-factor, not one.
Which is why we talk about the euro every day, Howard. This was great.
Thank God.
Howard Marks of Oaktree. Howard, you're just one of the best, and we appreciate it. Thanks for giving us so much of your time, sir. The euro right now negative by 0.1%, 108.84. I feel terrible doing this now with Howard sitting next to me. Traders effectively betting on more cuts from the ECB off the back of these forecasts from the central bank.
Look, it matters to a lot of people, and I will say this, it depends on whether they see that weakening in the economy as coming along with the inflation coming down. I want to hear from her about the Houthi attacks and what that's going to do to potential price pressures.
A lot of questions, I imagine, on that story. ECB President Christine Lagarde, that news conference starting in about 20 minutes' time. There is a bid in the bond market. Treasury yields a little bit lower off the back of that decision. We'll catch up with Michael Gapin of Bank of America in just a moment. Michael McKee is going to break down jobless claims for you. All of that coming up next. Got some economic data in just a moment. Jobless claims. Mike McKee's going to break them down for you. Equity futures right now positive by a third of 1%, up a half of 1% on the NASDAQ. If you look at the bond market, there's a rally here. Yields are lower now in the US by, let's call it 3 basis points, 4.07%. In Germany, we're down 6 basis points at 2.26 off the back of the ECB's forecast. Inflation lower than expected. Does that open the door to rate cuts of the ECB sometime soon? The euro lower, negative, weaker euro, 108.83. With those jobless claims data and a whole lot more, here's Mike McKee. Hey, Mike.
John, we've been talking about a lot of layoff announcements coming through the news, but it's not showing up in the numbers. Only 217,000 jobless claims last week. That compares to revised 217 the week before. Had initially come in at 215, so no real change there. The number of people who are still getting claims, 1,906,000. That's up from 1,898,000, which is a revision a little bit lower. So the continuing claims numbers not really telling you anything different either. The length of time people are taking to get a job hasn't changed significantly. The other big news of the day, the trade balance comes in unexpectedly high at $67.4 billion instead of $64.2 billion. So that's going to be a subtraction from first quarter growth. This is the first January number we have on it. So a little bit of a surprise there. Productivity and unit labor costs, their third revision productivity is unchanged at 3.2%, and the unit labor costs come in a little bit lower, 0.4% from 0.5%. The productivity numbers are interesting, not necessarily because they changed at all, but because they have been so high. It's been one reason that inflation's going down here, and it is a big difference between what's happening in the U.S. and what's happening in Europe, where they have about 0.6 productivity. So it shows you one reason why maybe our yields are going to stay a little bit higher and our economy is going to grow a little faster.
Hard to get a clean read on the price action off the back of this, because this economic data that just came out is in combat with what we've just heard from the ECB and the forecast for inflation. This is where we stand. Equity futures positive by 0.4% on the S&P 500, on the NASDAQ 100 up by 0.6. In the bond market, yields were down by, let's call it 2 basis points on a 10-year going into that jobless claim figure, now down by 3 to 4.0691% on a 10-year maturity. On a 2-year, 452, down by 3 basis points. Lisa, if I was to put it all together, just looking at the jobs data, just in terms of the market reaction to it, this is just another one in a list of them now so far this week where in line or downside surprise is good news. And it was the same as PCE in the last week, by the way, as well. It's the absence of blowout beats like the ones we were getting in January that I think encourages this market just a little bit more.
It's the absence of the tail risk of a potential reacceleration in growth and therefore in inflation. If you don't get that, that is considered a very positive thing for this market. I will just say, though, to Mike's point, there's a real question here, especially with the ECB coming out and projecting weaker growth and weaker inflation. Does the U.S. stand alone, or is it kind of together with what the ECB does and with your region? And the reason why I ask is because bond markets are very much trading in tandem still, even though we keep saying the U.S. economy is doing a lot better and has a lot more momentum.
First question you ask in this news conference today, why haven't you just cut interest rates? Isn't that the question you ask in about 12 minutes' time based on what they've just told us?
Absolutely. If you are projecting lower growth, if you see recession in Germany, if you see inflation coming under control, what's holding you back right now?
Mike McKee, what would you ask in that news conference? Take your Federal Reserve chops over to the ECB. What would you say?
Well, I think that's a good question about timing, because the ECB sees momentum that is perhaps stronger than the Fed, down towards 2%, and they're anticipating they get there sooner. And so they could move now, and that might be something that could give them a little bit of a tailwind at a time when the U.S. is lapping them. The futures prices now, swaps are pricing in basically a move in June for the ECB from July, but the Fed is still out there in July. We'll see what happens after tomorrow's jobs report.
Yeah, and what happens today also at 10 a.m. when we do hear for day 2, Chair Powell on the Hill.
I don't think you'll get much there.
Well, maybe not, but I do think it's telling that the enthusiasm we're seeing in the equity markets and bond markets hasn't shaken this feeling that there are going to be cosmetic cuts or, trimming around the edges later this year. What are you looking to hear from him today?
Well, what I would like to hear from him is a little bit more on the criteria that go into when they cut rates and try to get a feel for this whole idea of whether they cut this year or not. But I think what we're going to get is pretty much a reiteration of what he said before. There's unfortunately nothing in it for him to answer my question.
Day two on Capitol Hill. Mike McKee, thank you, sir. Chairman Powell in front of the House Financial Services Committee yesterday, in front of the Senate Banking Committee a little bit later. And I guess the highlight of that might be Senator Warren coming up a little bit later, and not on monetary policy. We've already heard what she thinks about that. Cut interest rates right now. It's got to be financial regulation later this morning.
Why are you taking away our gateway to protection against the largest banks? You should be increasing some of the capital holding, not taking it away. I'm curious about whether he walks back some of his proclamations from yesterday, given some of the criticism that maybe he was front-running his compatriot Michael Barr from the Vice Chair of Supervision.
It's an interesting question. Mike Gapen with us now, Bank of America. Mike, don't worry. We're not going to talk about how happy Brian might be with that move from Chairman Powell yesterday. I want to talk about monetary policy with you. The ECB opening the door to a rate cut in many ways. That news conference is going to start in just a moment. Can you frame the differences between what they're looking at the moment over in Europe and what you're looking at over in the United States for the Federal Reserve?
Yeah, I would just say as a policymaker, it's a lot easier to justify action if growth is slowing that meaningfully, right? So if inflation's coming down and growth is weakening, it's obvious. Then it is about timing, not necessarily direction. In the U.S., it's a different story, right? The direction of travel has been towards firmer growth and then questioning, well, how quickly does inflation come down? So the Fed says that narrative, where most of this appears to be supply-side driven, suggests we can ease later this year. But then there's caution and balance of risk. So it's a little trickier, requires more nuance from the Fed.
We know why there's caution, because we just had this really boomy data to start 2024. Right. So far, it doesn't look like February is confirming January. Are you expecting that from the payrolls report tomorrow morning?
Yes, in the sense that I don't suspect we added 350,000 jobs in January. I do think some of the seasonals have been slow to catch up. So there's some noise, some signal. I don't think it was a weak number. I think the labor market probably held up just fine. We're a touch stronger than where consensus is at 215,000, but that's about in line with what the 6-month average has been. So I think that the December-January turn had a lot of noise. I think the February data is saying, yeah, things are cooling on the margin. Don't look for reacceleration. So as you said, Lisa, that's kind of the big narrative driver. Are we reaccelerating or just showing resilience? We're in the latter camp.
So what would it take for you to enter the camp that we've been talking about, which is the no rate cut camp, which is getting bigger and is actually attracting more and more?
Yeah, so I think you'd need a number closer to January, and probably at least above 250. Maybe closer to 275, but I think it would have to be accompanied with other information like wage growth is picking up, the decline in hours worked has reversed. So I think you need some more context beyond just the employment number. But yes, something like that would probably reduce odds in June substantially. And the trick there is that there are some in the market who say, well, if the Fed doesn't move by June, they're not going to move this year. So you could see kind of a peeling off of rate expectations very quickly. If you take off June, some in the market may be inclined to take off September as well.
Last night I was going through the data. I was going through Quits data from Jolts. I was going through a whole host of others. And I was struck by the narrative roulette we've experienced over the past year or two. And this idea that we can't get our heads, or I can't get my head around, okay data that doesn't really have a direction, that sort of is good enough but doesn't really suggest what's going to happen in the future and is messy. What do you make with data like that?
Yeah, I would say that from the economist point of view, I would say, I'd add, and if it's a lot about a supply shock, you get reactions that look different than you're accustomed to. Meaning we usually think, oh, strong growth leads to overheating effects. And we're wary of that, and we're concerned about that. But over the last 1 to 2 years, it's been the opposite, right? So it's a world where we can coexist with strong growth, low unemployment, declining inflation, right? We're not used to that. So the data being okay, we may not have a reaccelerating story, but it's still one that's tricky to navigate.
Right now, when you look forward, what is going to be the key data point that's really going to drive some of your forecasts, as everyone seems to be climbing on the Goldilocks scenario?
I would still say the two most consistent data points, the December to January turn aside, is the employment data and the inflation data. Seasonally adjusting a $27 trillion economy through a pandemic, really hard. But it's got to be easier to count. Got to be easier to count people in seats and what we're paying for things.
CPI next week. Best guess. Where are we a week from now? We've got Payrolls in hand, we'll have CPI in hand, we will have just got retail sales as well. Where do you think we'll be? How would you describe that moment?
Labor market holding up, but cooling on the margin only a bit. We think core CPI will come in at 0.3, so maybe alleviating some fears of reacceleration. Our credit and debit card data suggest retail spending is softening. So again, probably okay, falls into Lisa's okay description.
Yep.
I think on net, that's where we'll be.
I think probably okay is probably what this equity market wants, right?
Oh, okay is perfect.
Probably okay.
But as long as it's okay with the look forward, that it will continue to be okay, right? I mean, that's sort of the key question, is what's our look forward when you have okay that's kind of messy?
Isn't that more good data? Isn't probably okay, Chairman Powell's more good data? Isn't that right?
That's what they want to see. He said it doesn't have to be better. It just has to be continually good. Interesting, though, when we say 215 is not that great. You know,
I know.
2 months ago, we were talking about 180 as being a strong number. So okay has a different definition these days.
Well, remember, a few months ago, we thought we'd get rate cuts in March, and here we are. It's March. Mike Gapon, good to see you. Michael Gapon from Bank of America. In the FX market, just want to bring your attention to what's happening with the euro at the moment. The euro is negative by 0.2%. It's 108.76. There is a bid in the bond market down 4 basis points on a 10-year Treasury. Over in Germany, the bid a little bit larger, yields are down by 7 basis points to 2.25. A big focus on the ECB, maybe Bramo cutting a little bit sooner off the back of those forecasts.
And a little bit more. Now talking about 100 basis points of rate cuts, which raises this question. What does that do for the euro trade, given the fact that we're talking about the potential for the Federal Reserve pushing back all of those rate cuts? All of the people who came on and said the consensus was the ECB would cut rates first.
Yep.
It's looking more and more like they're right.
This is the FX market you'd be excited about. If we can push the Fed out a little bit further, bring the ECB in, pump up how many cuts we get from the ECB, reduce them from the Fed, you've got a little bit more of a trade there.
You would think, right? And that would think, well, that would be quite a bit of dollar strength, considering the fact that you're also having a stronger than expected economy in the U.S. So it's surprising to me that there isn't more of a response, frankly.
That news conference with President Lagarde starts in about 3 minutes' time. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. One of the world's biggest ship crew unions is urging all vessels to reconsider sailing through the Red Sea after yesterday's deadly attack from Houthi militants. Nautilus International, which represents 20,000 workers, says the utmost priority should be safeguarding the lives of seafarers. The death of 3 crew members marks the first loss of life since the attacks began last November. Donald Trump wants to debate Joe Biden. The former president posted on Truth Social, "I'm calling for debates anytime, anywhere, any place." Trump skipped the debates during the Republican primary. A Biden campaign spokesman says if Trump is desperate to see the president primetime, he can watch a State of the Union tonight. Shares of Novo Nordisk gaining after the Dutch drug maker released promising data on an experimental daily weight loss pill. The company says the new treatment helped patients shed 13% of their weight over 12 weeks use. In a meeting with investors, Novo said the study was small but provides a basis for further development of the pill. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, President Biden charting a path forward.
Americans are very fed up and frustrated with Washington for a whole slew of issues. President Biden is going to try today to present himself as a problem solver who's been adept at addressing some of those issues despite the dysfunction.
We'll head down to Washington, D.C. and catch up with Annmarie in just a moment. Equity futures are positive by 0.4%. Your opening bell is just around the corner. Frankfurt, Germany, really interesting news conference just beginning with ECB President Christine Lagarde. You get some opening comments. The Q&A, when that begins, we're going to go over to it. In the moment we're looking at right now, we've got a euro that's negative by around about 0.1% against the dollar, 108.83, off the back of these inflation forecasts from the ECB. Bramo teeing up a rate cut pretty soon based on this. They're telling you 2%, 2025, near term. We revised that forecast for inflation lower.
And I think, again, you asked the really good question, why aren't they cutting rates today if this is their forecast at a time where a lot of people have been talking about recession? In Germany is really leading the ship lower.
Bond market rally in Germany, stateside as well. Yields lower here by 4 or 5 basis points, 4.0556% on a US 10-year. Under surveillance this morning, President Biden charting a path forward.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics. Americans are very fed up and frustrated with Washington for a whole slew of issues. President Biden is going to try today to present himself as a problem solver who's been adept at addressing some of those issues despite the dysfunction.
Here's the latest. The president delivering his State of the Union address tonight. Biden expected to defend his foreign aid and border policies and handling of the economy. Voters watching not only for what he says, but how he says it, as concerns about his age and mental acuity mount in the polls. Annmarie back with us down in Washington. AMH, just how big is this moment for the president?
Well, everyone in Washington is really calling this the most important speech, Jonathan, of his presidency, but not just because it's a normal State of the Union in sense of constitutionally he has to give this report to the American people, but also this is a campaign speech. He is obviously going to be trying to differentiate himself from former President Donald Trump and why he thinks the American people should give him 4 more years. You know, we heard from Mohammed Yunus there, and he was saying that his approval rating right now is low in the Carter world. A line that I keep hearing from both Democrats and Republicans is what Reagan said about Carter. Are you better now than you were 4 years ago? Well, how Biden is going to talk about that today is going to be trying to remind the American people where they were 4 years ago, March 2020, when the world shut down in COVID. And now we actually are joined by Congresswoman Abigail Spanberger of Virginia, a Democrat representing a swing district, not just a swing state, and also a candidacy for Virginia governor. Congresswoman, thank you so much. I want to start in Virginia. Trump obviously won the primary there, but Nikki Haley had a pretty strong showing in Northern Virginia. And what we know from the Biden campaign is that they want to welcome these voters. How does he speak to those voters today? More moderate-leaning Republicans or independents?
Well, it wasn't just Northern Virginia. It was Williamsburg, it was Charlottesville, it was Albemarle County. There are pockets throughout the Commonwealth of Virginia where we did see that Haley did well. And I think the way that the president speaks to all voters, all Americans, is by talking about what our vision, our shared goals are. I want to hear the president talk about the issues that are front of mind for so many Americans. And certainly, you know, that begins with our fundamental freedoms, specifically abortion rights and reproductive rights after what we saw the Supreme Court in Alabama do. That's front of mind for so many voters, certainly across Virginia. I want to hear him talk about the concerns that so many people have across Virginia about fentanyl and the immigration challenges, the need for border security and immigration reforms. Certainly front of mind is the issue of national security and whether we will be able to move forward with Ukraine and the national security supplemental. And then ultimately the day-to-day challenges facing so many Americans, costs, mortgages, home rental prices, costs at the grocery store. These are the things that are top of mind for so many people across Virginia. And I think if the president's speaking to those things, not only will that be potentially positive and inviting messages for those who already rejected Donald Trump at the ballot box by voting for Nikki Haley, but also an important message for all Americans.
Well, poll after poll continues to show that voters actually think Trump would be better when it comes to handling some of those issues you just outlined. In 2021, in the New York Times, you gave this quote, nobody elected him, Biden, to be FDR. They elected him to be normal and stop the chaos. Do you think he's become more normal, in your words, over the course of his presidency?
Absolutely. You know, I have 3 school-age children. One in elementary school, one in middle, one in high school. And what I know is that now we are back to putting our kids on the bus. We are not worried about a global pandemic. We are not worried about the shutdowns that we saw in early 2020 and into 2021. In fact, we are back to some level of normalcy that so many Americans felt. There is so much room to make continued improvements and continued progress. But yes, I do think that actually the president settled into what I do continue to believe was his mandate, which was to settle things in the aftermath of the pandemic and get back to governing. Now, the fact that Congress isn't always a willing partner and the Republican majority in the House is not always a willing partner, that's an entirely separate issue. But in terms of being a steady hand, in terms of demonstrating the level of normalcy and the calm from the chaos that was the entirety of Donald Trump's 4-year presidency, I think that President Biden has done a very strong job and followed the mandate that I think he was sent to Washington with.
You mentioned immigration as a top issue. Gallup polling shows that now, since 2019, it is the top issue on American voters. You were a former intel officer. You dealt with some of these drug cartels. Is this problem worse than ever before you've seen, given your intel background?
So I think there's multiple factors here. Certainly there is the issue of drug trafficking. There's the strength of drug and transnational criminal organizations. And as you mentioned, I'm a former CIA officer. Also before that, I worked narcotics and money laundering as a federal law enforcement officer. So there are elements of the challenges that we face, the larger scale kind of international issues, but then the reality that we as a nation have an immigration system that is not working. It is outdated. It has not been reformed in a generation. And we see that day by day when people are coming to the United States and rightfully, as is their right, trying to apply for asylum. But the backlog and the wait is years and years and years. I have farmers and producers and industry across my district that want to hire workers from abroad, hospital systems that want to bring in nurses and doctors, farmers that want to hire folks under the H-2A program, and they cannot do it because there simply are not enough visas to meet the demand that they have. The system is, the challenges in the system are comprehensive, which is why we need real reforms.
But barring that reform, should Biden use his executive authority and shut the border?
I think at this point in time, Biden, the president, should be looking at pursuing any and all authorities that are within the realm of possibility for the president. But we have to be clear about why we are talking about the president taking executive action. There is a need potentially for the president to use every tool in his toolbox, because when Democrats and Republicans and the White House engaged and worked for months to pull together a bipartisan, policy-focused bill that would reform our immigration system and make substantial and comprehensive immigration updates to our border security protocols and policies. And that was brought to the United States Senate, initially viewed as a tremendous success. And my hat's off to the Republican senators who worked on that with Democratic partners and the White House. Immediately, former President Trump signaled that he didn't support it. Speaker Johnson said it would be dead on arrival in the United States House, and they crushed any and all hopes of what would have been a monumental step forward in policymaking. And so it is within that construct that we are now talking about potentially what sort of scratches at the surface exists within the president's toolbox, because the folks in this building and the Republican majority and Speaker Johnson refuse to take meaningful action. We are here to govern and legislate, and they are refusing to do it.
Congresswoman, thank you so much, Tom. We really appreciate it. Congresswoman Abigail Spanberger of Virginia. And Jonathan, she represents a swing district. And also, if she was able to win the governorship of Virginia, she'll be representing a purple state. So she's been one of those individuals that within the Democratic Party has been very vocal. That 2021 New York Times quote stands out to me. No one elected you to be FDR. They elected you to be normal. And she thinks he settled in to normalcy.
I remember that piece. AMH, thank you. Great work down in Washington. That State of the Union coming a little bit later on this evening. Coming up tomorrow, CFTC Commissioner Caroline Pham, JP Morgan's Priya Misra, former Fed Governor Betsy Duke and Libby Cantrell of PIMCO. We'll be speaking to Mohamed Al-Aaron as well on Payrolls Friday. We can now head over to Frankfurt, Germany. The ECB President Christine Lagarde driving through her opening statement. The Q&A about to begin in just a moment. Let's take a listen.
And the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could be higher if inflation comes down more quickly than expected and rising real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Upside risks to inflation include the heightened geopolitical tensions, especially in the Middle East, which could push energy prices and freight costs higher in the near term and disrupt global trade. inflation could also turn out higher than anticipated if wages increase by more than expected or profit margins prove more resilient. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Financial monetary conditions now. Market interest rates have risen since our January meeting, and our monetary policy has kept broader financing conditions restrictive. Lending rates on business loans have broadly stabilized, while mortgage rates declined in December and January. Nevertheless, lending rates remain elevated at 5.2% for business loans and 3.9% for mortgages.